Stream is live.
Students will be seeing me live, right?
Yes, sir, from YouTube. It's streaming right now.
Is it started?
Yes, sir, it started.
Okay, okay.
I'll turn off my video and audio.
Sorry.
I'll turn off my audio and video.
Sure. Okay. So very good morning, students. So today we are here for the revision for November 2023 for the subject financial management. So talking about my introduction, I am CA Thofik Tufel. So I'll just give a small introduction about myself. So I am CA Thofik Tufel and I have qualified my chartered accountancy in 2022. So after that, I worked as a finance controller in a Fortune 500 company, and then now I'm a practicing chartered accountant. Talking about financial management, so I'm teaching this subject and I started this subject this year only. So what is the agenda for today's class and what will be the agenda for the entire financial management subject is what we are going to discuss now. So when we start with today's class, so I've been allocated around 9 hours. So 9 hours for financial management, and you all know that it is not, practically possible to entirely like 100% revise financial management in this small amount of time, but I will do justice to the subject to the extent possible. Now, when we talk about financial management as a subject, it carries, so it is paper number, you all know which paper is, so yeah, so it is paper number 8, and this subject is coupled with economics for finance. So economics will be handled by some other faculty and I'll be handling financial management. Financial management, let me talk about this thing first, that financial management is a very scoring subject. Here it will not be a lengthy subject, unlike accounting. If you see accounting, you'll be having many concepts, partnership and consolidated financial statements. The whole chunk of accounting standards are there. But when it comes to financial management is a very structured subject. It is a very straightforward subject. So that is the reason problems can be little challenging in financial management. If you see in the entire 8 subjects, wherever challenging problems are possible, it is possible only in the subject of financial management. They cannot put much challenges in accounting, or they cannot, twist and turns in other subjects. But here they can do whatever they want. Financial management. Number one, it is a concept oriented subject. So there is no element of mugging up or memorizing the subject. And point number two is that theory should also be given equal importance, is because theory also covers a good portion of marks. I'm not telling theory is covering 50-50, but you all know that theory is covering at least 15 to 20% of the syllabus. Theory is covered, and only from few chapters theories are possible. Like first chapter is entirely theoretical, second chapter is entirely theoretical, and here and there few more theory questions can be expected. Now, when we come to today's agenda, today we have a class from 9 to 1. So 9 to 1, it's a 4 hour. So we will give a small half an hour break in between. So in this effectively three and a half hours, what I will be targeting is that I'll be targeting the financing decision first. So financing decisions will be today's target. Then tomorrow we will come into investing decision, dividend decision, and then the other chapters. So listen to me for the first 15 to 20 minutes. For the first 15 to 20 minutes, I'll be talking something theoretical. You will feel it is dry, but trust me, this will be important for the base. This will be important to, have a pace for the subject. If I directly jump into, okay, what is financing decision, cost of capital, these are the formulas, you all will get lost somewhere. So that is the reason what I have thought is that to keep the pace not slow because we have our exams, not very fast because it is no use if we are just going on and nothing we are understanding. So we will keep our pace in a medium pace, and I'll keep this subject as and I'll present this subject as structurally as possible so that this video can also be seen 1.5 days before the exam. So we have 1.5 days. So this video can also be seen 1.5 days before the exam just to brush through the concepts. We will brush through the concepts. The prerequisite of attending or the prerequisite of watching this video is that you should have completed the subject from your end at least once. At least once you should have completed this subject. Only after completion of the subject, this class will help you to brush through all the concepts. But one more advantage of this class is that through this class you will be at least getting clarity in few topics, because what happens when we study our subject, few topics we will just leave it in blue. So through this class, those topics also we will touch, and you will get to know what are all the things that are there, what are the types of problems possible, and out of those types of problems, I will give you approach how to solve the problem, some tips, some tactics. So we will not be solving much problems. This will not be a problem-oriented class, but this will be a revision-oriented class, and that too revision of all the concepts, formulas, and theory whatever is there in financial management. So with this introduction, let us start. So hear me out for the next 10 to 15 minutes. You will feel it is little bit theoretical, but it will help us to take the class forward. So we are studying financial management. So if you can see, these are all the chapters which are there in financial management. These are all the chapters which are there. We have total 10 chapters. In these 10 chapters, first chapter is the basic chapter. Second chapter is a theory chapter. At least one or two questions of theory is possible from second chapter. Then ratio analysis. Then we have cost of capital, capital structure, and leverages. These three comes under the bucket of financing decisions. Then we have investment decisions. One is capital budgeting, and second one is risk analysis in capital budgeting. Now note here, this risk analysis in capital budgeting in new syllabus, now the syllabus have been changed. So in new syllabus of Inter, we don't have this chapter risk analysis in capital budgeting. So they have moved from CA Inter. So there is a high probability in this exam. In this exam, November 2023, there is a high probability that one question, at least a one good question or one or two questions will be asked from risk analysis in capital budgeting. You'll be lucky if they ask two questions, but one question definitely will be asked from risk analysis in capital budgeting, and that too a very good problem for may say 8 marks. This problem will be asked. And then we have dividend decision and management of working capital. So since we have we have only 9 or 10 hours of cumulative time, so it is not possible to entirely cover, but I'll go in the ABC category, right? So if you know this financing decision, investment decision, and dividend decision, chapter number 4 to chapter number 9, this is the major chunk of financial management. If you cover chapter number 4 to chapter number 9, that covers almost 75% of the financial management subject entirely. And trust me, all these chapters from chapter number 4 to chapter number 9 are very easy, very structural, and everything is formula oriented, except one, capital budgeting. Capital budgeting alone requires some level of good understanding. But under capital budgeting also we have different types of problems. So in that, if we have a case study problem in capital budgeting, that is where some extra efforts are required to understand the question, to read the question, and then to identify what to do. Other than that, everything is formula oriented. Once you know the formula, apply the numbers, plug in the numbers into the formula, and we will get the answer. Okay, so this is the basics. to start with. Now, when we talk about financial management, we always have this question: what is financial management? What is financial management? Financial management, as you all know, it is two terms: financial and management. Okay, financial and management. So you all will be understanding, okay, something managing the finance is called financial management. Okay, so you all know, okay, it is finance. Finance means money. So financial management, management of money. Okay, now, when we talk about management, who does the management part? Who does the management? In any company, always make a note that whenever we are studying financial management, we are not studying financial management from an individual perspective. Okay, this is not a personal finance subject. This is a financial management from a company's perspective. We will always see from a company's perspective. You all know, in companies we have different types of managers. So a manager, the work of the manager, so is to do management. Okay, so who does the management? The manager does the management part. Okay, why I'm going little slow in the start is what is required to take the pace ahead. So if I directly jump into the topic, you will not be very interested in the subject. You lose interest in the subject. That is the reason this is the presentation. Don't worry, the entire subject will not be presentation oriented. I know presentations become boring at inter level, even at a final level, but trust me, this is required in starting, is because to gain interest. Okay, now what is financial management? Financial management, two words for management of money. Okay, management of money. See, even if you see the definition of financial management in your textbook, so financial management is the managerial activity which is concerned with planning and controlling. So what we are doing, planning and controlling the firm's resources. Firm's resources, na, it is finances only. Okay, now when we talk about manager, what does the manager do? In every company we will have manager. What is the work of manager? What is the work of manager? Why we are paying so much hefty salaries to manager? Because they take decisions. So to sum it up, financial management is all about taking decisions. Is all about taking decisions. Taking decisions about marriage decisions. No, taking decisions about money. Taking decisions about money. Okay, so you all, we have summed it up. Financial management is about taking decisions related to money, taking decisions related to finance. Okay, taking decisions related to finance. Usually, the head of finance in any company is the chief financial officer, CFO. We have a hierarchy, right? CEO, CFO, and then different types of officers are there in the business. So usually this financial management is taken care by CFO. Now now this was a theory part. Now, what are all the theory questions? You can make note of it. From first chapter, what are all the theory questions which are important from exam perspective and which can be asked in exams? Okay. See, one question which is asked many times is that what is the role of CFO? What is the role of CFO? If you open the textbook, you will get the explanation. What is the role of a CFO? A CFO used to do budgeting. A CFO used to do the forecasting of the business. A CFO used to, manage money. He used to manage the treasury of the business. They will prepare. So these are all the roles of the a finance executive. Either the question would be what is the role of a finance executive, or the question would be what is the role of a chief financial officer. So this is the first question which is possible from the first chapter. Right now we are discussing first chapter. Okay, what is first chapter? It is objectives of financial management, the scope and objectives of financial management. Okay, this is one question. So this is one question. Second thing, the second question which is there is why financial management is important. They can ask a direct question: importance of financial management, scope of financial management, something like that. Now you don't have to mug up. Okay, you don't have to mug up. Let me tell you one tip for theory subject. Whenever a direct theory is there in the book, okay, whenever a direct theory is there in the book and it is written point wise, Now, for example, there are some 4 to 5 points, there are some 5 to 6 points only. So you have to write at least, if it is a 4-mark question, at least 5 points you have to write to get 4 marks. You have to write 4 points, but at least to a safer side, you write at least 5 points. Okay, if there are 5 points, 6 points, or 7 points in the book. Now, if the question is point wise, okay, if the answer to the question is point wise, one tip that I would give you is that always try to create some abbreviations. Okay, if it is important, don't create abbreviations for all the questions, otherwise you will get mess up in the examination. Wherever it is important, try to create abbreviations. Okay, if it is importance of financial management, try to create some abbreviations. So if it would be a regular class, I would help you to create a abbreviation, but you have to create some abbreviation on your own. Something, if there are 3 INA, just put I cube. Okay, something like that. You have to create some creativity, you have to use just to remember. Because in exam what is tested is not your concepts. In exam what is tested is how far you're remembering the concepts from. Okay, now you know all the concepts, but in the exam, if you get mess up in the exams, if you're not able to write the concept, it is of no use. Okay, the examiner will not know whether you're an expert or whether you're a PhD in financial management unless you write the answer. So to writing the answer, remembering is very important, and to remember, some tactics you have to use. Okay, so important questions is what we are discussing from chapter number 1. One important question is that the role of finance executive or the role of CFO. Very important question. Okay, very important question. Many times it has asked. Okay, second thing, when we talk about financial management deals with decisions. Okay, deals with decisions. Okay, financial management deals with decisions that we have to take. Okay, now what are all the types of decisions? What are all the types of decisions? See, everything you already know. I won't explain anything, I'll just directly write. We have 3 types of decisions. Okay, one is financing decisions. Okay, then investing decisions. Okay, we have financing decisions, we have investment decisions. Okay, investment decisions, and then we have dividend decisions. Okay, majority a finance manager, or we call the chief financial officer, CFO, finance manager, deals in taking decisions, and broadly all the decisions can be categorized in these 3 buckets: financing decisions, investment decisions, and dividend decisions. Any balance sheet of the business. Okay, any balance sheet of the business, liability side and asset side. You all know liability side will contain sources of funds. Okay, the sources of funds, and in asset side it will contains application of funds. This is the core of financial management. Whenever we talk about liability side of the balance sheet, liability side talks about from where the fund will come. Okay, whether you'll take the fund from the bank, whether, see, one thing, if I want 100 crores, okay, I have some project, I have a business. Okay, I want to buy a factory. Okay, the worth of the factory is 100 crore, which means I want to invest 100 crores. From where I will get 100 crores? I will beg, I will borrow, I will steal. From where I will get 100 crores? I have to source, correct? I have to source from somewhere. Now, from where I have to source? Either from equity I can take, or from debt I can take, or from preference shares I can take, okay, or from bank loans I can take. Okay, so these are the sources of funds. Now, if I have sourced 100 crores from these sources, okay, 100 crores I have sources, and that 100 crores I have sourcing, this is what is called financing decisions. This is what is called financing decisions. Now, what is the decision that I have to take from financing decisions? If somebody is giving me money, will I get money for free? Nothing. Okay, nothing we get for free. Always there is a cost. Always there is a cost. So to find out what is the cost of this 100 crore is one decision. Is one decision. You all know this is capital. Okay, this is what is called the sources of funds. This is what is called as capital, equity capital, debt capital. Capital does not only means share capital. In financial management, long term money is called capital. Whatever amount we are taking for long term is capital. It can be equity capital, debt capital. Okay, it can be loan. Capital means money which is used for long term purpose. So the first decision that I have to take is that what is the cost. Okay, this is one decision that I have to take. The cost of capital. The cost of capital. Second one, entirely have to take equity, entirely have to take debt, or entirely have to take loan, or I can use some permutation combinations. 10% equity, 90% debt, 50% equity, 50% debt. What should be my debt equity ratio? So this is what is called capital structure. First you should know that you have to take money, and that is called as capital. You have to take money at what cost, which is cost of capital. Now in what structure you will take money from? You will take money from half from equity, half from debt, or entirely from debt, or entirely from equity. Now this is what is called as capital structure. That is what is called as capital structure. I am trying to bring the entire subject in one page for you to consolidate the entire discussion in the end, for you to appreciate the subject. That is what is my intention for today's class. Okay, my intention for today's class is to consolidate all the chapters, or consolidate whatever topics or concepts possible in entirely in the short period of time, so that it will be easy for you to understand and easy for you to link. Okay, it would be easy for you to link. So first is cost of capital. If I'm raising money, at what cost I will raise. Second thing is, in what will be the structure. Okay, what will be the structure. Third thing is I will have something called as leverages. Okay, I will have something called as leverages. See, what is leverage? Okay, leverage is an advantage, or leverage is also a risk. So whenever we are taking any debt, we have to pay something called as interest cost. So interest cost is fixed cost. Okay. See, when we are taking equity, we will pay dividend. When we take debt, we will pay interest. When we take preference share capital, we will again pay preference dividend. When we pay bank loan, we will pay something called as interest, and all these are fixed cost. Now, because of fixed cost, there can either be an advantage, or there can either be a disadvantage. You all know that higher the fixed cost, higher is the risk. Okay, and higher is the risk, and if the profits are increasing, you will get some you will get some leverage. So suppose if your debt equity ratio is more, so you are having high leverages, and say if your financial leverage is 2 times. When I say my financial leverage is 2 times, financial leverage 2 times, now what is the meaning? 1 rupee increase in sales will have 2 rupee increase in profit. That is what is called as financial leverage of 2 times. Okay, so 2 times means it is just that rupee increase in something will have an increase in something, an increase in one variable. If it is increasing the other variable by how many times, it was it with what is called as leverages. So financing decisions affect our leverages. Why? Because more debt now, more fixed cost, now more will be the leverage. So these three chapters comes under the bucket of financing decisions. Okay, till here, if it is clarified, now 100 crore we have taken. 100 crore, where to invest? Where to invest? One is that I have some alcohol factory. Okay, I can invest in alcohol factory. Okay, one is I am having a biscuit factory. I'm having a biscuit factory. Second one, I can trade in stock markets. Okay, I'm trading stock markets. Okay, third is no risk I want to take. I will put in bank FD. I'll put in bank FD. Okay, these are all the projects. You in financial management, these are the alternatives. Okay, these are the different alternatives where you can apply your money. Okay, say these are the projects. Okay, project A is alcohol factory. Project B is biscuit factory. Project C, you will give some money to the portfolio manager and he will trade in the stock markets. Project D, nothing I will do. I put in bank FD and I will earn some interest. I will earn some interest. Now, what to do? Okay, what to do? Whether I should put in alcohol factory. Yeah, sir, alcohol factory is giving me 25% return, sir. Sir, biscuit factory is giving me 15% return, sir. Sir, stock market is giving me 18% return, sir. Sir, bank FD is only giving me 6% return, sir. Where you should put? Definitely, sir. Stock market I should put. No, no. Alcohol factory I should put. It is 25%, sir. Very good, sir. Wherever the return is more, you have to put. No, some decisions you have to take, right? Alcohol factory. Is it good to invest in alcohol? Okay, see, financially, if you talk, it is good. It is good to invest in alcohol factory, but many other factors also should be taken care of. Social factors should be taken care of. Risk should be taken care of. What are all the types of risk? Tomorrow government changes, directly they ban alcohol. Now this entirely 25 goes for a toss, but no one will ban biscuits. Correct. So this 50 is having less risk. This 25 is having more risk. So all these things we have to take care, right? All these things we have to take care. Now, to take care of all these decisions, where to invest, what to invest, this is what is called as capital budgeting decisions. This is what is called as capital budgeting decisions. The chapter name is investment decisions. The chapter name is investment decisions. We will have some techniques. We will have some techniques. Through these techniques, we will identify which project we have to choose. Okay, we are having different techniques in investment decisions. Through the techniques, we will find out in which project I should invest. This is what is capital budgeting decisions or investment decisions. And just an advanced version of investment decision is what is risk analysis and capital budgeting. Okay, risk analysis and capital budgeting. Chapter 1. And this is one more chapter. See, 3 chapters will be covered in financing decisions. 2 chapters will be covered in investment decisions. Okay, these are the 2 decisions a finance manager will take. What is the third decision a finance manager will take? Okay, now from this 100 crore, say you have earned a profit, profit after tax of 20 crore rupees, profit after tax. Okay, you took the money, you invested the money. After investing the money, you got the profit of 20 crore rupees. Now, with this 20 crore rupees, what you should do? Okay, there are only 2 options possible. Either you retain the money and invest in the business. Second thing, you pay to the equity shareholders as dividend. Okay, because only after paying to debt holders, after paying to loan, or after paying to preference shareholders, this will be the profit. Okay, not preference shareholders. After paying to debt holders, after paying to bank loans, this will be the profit after tax. Okay, so equity you have already paid, bank loans you have already paid. Now, this equity shareholders is what is called as the owners of the company. So, the real owner of this 20 crore is who is the shareholder. Now, you have to take only 2 decisions are possible. Either to keep this money, invest in the business because you're having some other projects in pipeline. Or the second thing is, I'm not having any projects in pipeline, directly give it to the equity shareholders. Only 2 things are possible. Okay, only 2 things are possible. Now, this third decision is what is called as dividend decisions. Is what is called as dividend decisions. Okay. So we discuss 3 decisions: financing decisions, investment decisions, and dividend decisions. This is one important question if theory. In theory, they can directly ask a finance manager what decision it will take. Or in financing decision, what does a finance manager do? Or in investment decision, what does a finance manager do? In dividend decision, what does the finance manager do? So whatever I discuss now, if you write it in a beautiful language, that becomes your answer. Okay. So how to write beautifully, you have to read the study material. Once you read the study material, you'll get to know how beautifully institute have written this answer. Whatever I've discussed is what is written in the institute's study material. What is happening, I have discussed in a very layman terms. I have discussed in the language that you will be understanding, but you have to write the answer which institute is expecting. What is institute is expecting? Institute is expecting beauty. Institute is expecting beauty. So write the answers beautifully. Don't write finance manager will come to the office and then, okay, nothing, no stories you have to write. You have to write the answers beautifully. How to write the answers beautifully? You have to read the study material. You have to read the language. Okay, you have to read the language. Okay, but we are not using any Shakespeare's language. It is very layman terms only. But the only thing is, you have to write the a right keyword, you have to write the right keyword which the institute is expecting. So when decisions come, so institute is expecting these three words: financing decision, investment decision, dividend decisions. When financing decisions are there, the institute is expecting these words, that from where the money will be financed, at what cost it will be financed, what should be the capital structure. All these things you have to discuss. All these things you have to discuss. And this is what, now these decisions are only breaked into chapters. As I said, there are three chapters that comes under the bucket of financing decisions, two chapters that comes under the bucket of investment decision. Then when we have one chapter which is dividend decision. So if you see, six chapters are covered when we talk about decisions only. Six chapters are covered when we talk about decisions only. Okay. Now we will start. Now we will start with financing decision. From here we will increase our space. Okay. From here we'll increase our pace. So if you think that you're not understanding or things are going above your head, so one thing that you have to take care is that, which means that you have not studied it enough. You have not studied it enough. Only if you studied at least once, okay. If you have gone through the subject at least one, you will be understanding whatever I'm speaking now. But if you have not studied, and if you're seeing this video for the first time, or if you're seeing this video after a long period of time, there is a possibility that things will go above your head. So nothing to worry. See this video one time or two time with study material in your hand, and then things will flow. Things will flow. Okay. Let us start with financing decisions. The first chapter we already completed. Okay. Objectives of financial management we already completed. There are only few questions possible and that I have discussed. But still, always have one reading of study material at least. Okay. Before exams, theory, one reading of study material is important, and whatever you feel important, highlight it or write some abbreviations, and that abbreviations you have to remember before the exams. Okay. With that abbreviations, you will get to know what answers you have to write, and you will get to know what are the keywords or what are the highlight points that the institute is expecting. So now we are starting off with cost of capital. We are starting off with cost of capital. So we will discuss this chapter very structurally. That is how I have prepared for this today's class. What I've prepared is that I will present this all the chapters in a very structured manner, so that you will first thing is you will have a thorough understanding, and second thing, you will know where you have to give priority and where you should not give priority. Okay. So when I'm talking about this chapter, cost of capital, okay, when I'm talking about this cost of capital, first let me tell you how many types of problems are possible. Okay, how many types of problems are possible. The first problem, it can be a small, okay, small 2 marks, 2, 3, 4 marks problem, which is cost of any individuals. Okay, cost of any individual source. Usually equity is asked. Usually equity is asked, which means they will give some details. They will give some details and they will tell you, okay, what is the cost of this irredeemable debt? What is the cost of this redeemable debenture? What is the cost of this preference shares? Okay, what is the cost of equity shares? And they will give you some details. So this is the first question possible. With the given details, you have to find out the cost. Second thing is they will give all the details and you have to find the cost of entire capital, which is weighted average cost of capital. Okay, here equity is important. Here weighted average cost of capital. This is very important. Weighted average cost of capital. This is the second type of question possible. This is the second type of question possible. Then the third type of question which is there is the cost of additional finance. Okay, this very less time they have asked, but still this is also a type of question which is there. Okay, what is the cost of the additional finance that I have to take? The cost of additional finance. Let me tell you this, only three types of problems are possible. Beyond that, nothing is possible from this chapter. And let me tell you, this chapter is completely formula oriented. Okay, we have few things. We have debentures, we have preference shares, retained earnings, equity shares. So we have only 4 or 5 sources, and in this 4 or 5 sources, some formulas are there. Okay, maximum 8 to 10 formulas. Maximum 8 to 10 formulas. Once you know these 8 to 10 formulas, entire subject can entire this chapter can be handled. Entire this chapter can be handled. So let me, just go cost of capital. So cost of capital, first thing is we have these are the types of capitals. Equity, retained earnings, preference shares, debentures and loans, etc. These are the sources. Okay, these are the types of capital that we are going to discuss in cost of capital. Okay, these are the only things that we are going to discuss in the cost of capital. So debentures, like convertible debentures is also there. Okay, in debentures there is one other type which is convertible debentures, that is also there. So these are the types. So to find out the cost of equity, find out the cost of retained earnings, find out the cost of preference shares, cost of debentures or cost of loan is what is the objective. Is what is the objective. Different formulas are there, and those formulas are also very simple. I'm telling you, all these formulas are very simple. Once you know all this formula, this entire thing can be handled properly. Okay. So, cost of capital is the return expected. Okay, it is the return expected, and it is always expressed in percentage. So when somebody is asking what is the cost of this debenture, don't tell 100 rupees interest. Okay, you have to express it in percentage. You have to express it in percentage. So that is what is cost of capital. It is always expressed in percentage. Okay. Now, whenever we receive any capital, we don't receive for free. We will have some outflow. We will have some outflow for this capital. Okay, now share capital, we have two types of share capital. One is equity share capital, another one is preference share capital. Then we have retained earnings, then we have debentures, then we have bonds. Okay, then we have bonds, and then we will have this loans. Okay, and then we will have this loans. Now, for equity share capital, what is the outflow that you'll pay? You'll pay dividend. But dividend is not fixed. Okay. Today you can pay 1 rupee dividend. Tomorrow you can pay 10 rupee dividend. Day after tomorrow you can pay 50 rupee dividend. Afterwards you cannot pay. You will not pay any dividend. No one is going to ask. So one cash flow, it is dividend, but it is not fixed. Okay. It is not fixed. Preference share capital also you will pay dividend, but here dividend is fixed. Here dividend is fixed. Okay. This is the only difference between equity share capital and preference share capital. Share capital you will pay dividend, but equity share capital is not fixed and preference share capital is fixed. Now for debentures, what you'll pay? Debentures you will pay something called as interest, and interest is fixed. Okay, interest is fixed. Bonds, what you will pay? Bonds also you will pay interest, and this interest is fixed. Loan, what you will pay? Loan also you will pay interest, and this interest is fixed. Now to find out the cost where the cash flow is fixed, it is very easy. It is very easy, correct? Now I am taking a 100 rupee loan. I know that I have to pay 10 rupee every year. So annual cash outflow divided whatever the amount I received is what is called as cost of capital. Okay, is what is called as, usually that is what is called my cost, correct? What is my return? 10 rupee I'm getting with an investment of 100 rupees. What is my return? 10 divided by 100 into 100, which is 10 percentage, correct? So opposite of return, cost, what is the amount that I'm paying? 10 rupees the amount that I'm paying is interest. What is the amount that I got? 100 rupees is the amount that I got. So what is the cost? 10% is the cost. 10 divided by 100. So wherever the cash flow is fixed, it is very easy. Annual cash flow in the denominator, the total cash flow that I received, which is that will be in the denominator, entirely cost is there. Okay, actual for what is the formula? The annual cash outflow, the annual cash outflow that I have to pay, it will come into the numerator. Denominator, what is the total amount that I received? That is what is called as the a denominator, and afterwards if you divide this you will get the cost bar. So fixed, it is very easy. So from this only you're understanding to find the cost of preference share capital, debentures, and all the loans, debentures, this loans, it is very easy. Now the challenge is where is that how you will find out the cost of equity share capital. That is where is the challenge. But you have set formulas for that. You have set formulas for that, and these formulas are based on assumptions. We will not discuss logically all the things because logically it will always take time. So we will see the direct formulas. We will solve some few problems just to have some comfort over the subject or the comfort over the concept, and then we'll move ahead. Okay. Now, let us start with cost of debentures. Let us start with cost of debentures. Okay. Cost of debentures in financial management. In financial management, cost of debentures is denoted at KD. Okay. Everything you already know. Why I'm telling this as if I'm telling for the first time is that for you to gain interest. I know you'll be thinking we already know. For we have studied many times, or maybe wrote exam many times. Sorry, but wrote exam many times. But what is why I'm telling this, in such a tone is that for you to gain some interest. For you to gain some interest. So cost of debentures, it is denoted as KD. We have two types of debentures. Okay, two formulas, two types of debentures: irredeemable debentures and redeemable debentures. Okay. Irredeemable debentures, now the amount that you have taken, you don't have to give that money back. It is irredeemable. It is irredeemable. You have taken 100 crores as debentures. You don't have to return this debentures. Sir, then it is equity only now. No, no. Equity, you'll pay some fixed. Okay. Here you're not paying anything. Equity, you don't pay anything fixed. Here you have to pay fixed interest perpetuity. You have to pay fixed interest perpetuity. Okay. So when you see in that way, the formula becomes what is the amount that you're paying? Interest is the amount that you're paying. Okay. What is the amount that you're getting? Net proceeds. Net proceeds is the amount that you're getting. Okay. Now, always in financial management, we will take the net cash outflow. If I'm paying 100 rupees of interest, on this 100 rupees, I will always get a tax benefit. What is this tax benefit? Tax shield. Okay. No need to get into much explanation because this is a revision. I know you already know these things. So we have to take cash flows and we have to take after cash flows. We have to take net cash outflow. So 1 minus T. Okay. Suppose if 100 rupee is the interest and 30% is the tax rate, if you want to calculate after tax cash flow, always you have to do the cash flow into 1 minus T. Okay. Cash flow into 1 minus T. What is the cash flow? 100. 1 minus what is T? 0.3. Okay. 30 percentage 0.3. So it is 100 into 1 minus 0.3 is equal to 0.7. It is 70 rupees. Okay. It is 70 rupees. So after tax cash flows, if you want to find out it, you always have to do 1 minus T. After tax cash flows, before tax cash flows, you have to convert it is divided by 1 minus T. Okay. Just concept. So this is the formula. This is the formula for irredeemable debentures. I into 1 minus T divided by NP. You always have to write I is equal to interest. Okay. I is equal to interest. T is equal to tax rate. Okay. NP is equal to net proceeds. Net proceeds. Now what is the amount that you got? And net, why I'm telling net? Okay, suppose I got 100. Suppose I've raised the debentures of 100 crores. Suppose I've raised the debentures for 100 crore rupees, but I have to pay some commission. Okay, some commission to the whoever has raised money. I have to pay some commission. That is called as flotation cost. So any cost that we have incurred while raising, that also we have to receive. So net proceeds if there are flotation cost, it is always after flotation cost. It is always after flotation cost. Now if people will ask, there is always one doubt. Okay, flotation cost usually will be given in percentages. Suppose if 2% is the flotation cost, one will be the issue price. Okay, In debentures, you have something called as issue price, and one is the face value. Okay, suppose the face value of the debenture is 100 rupees. Suppose for just example, I'm assuming that we are taking only one debentures. We are taking only one debenture. Okay. Now face value is 100 rupees. Okay. But I'm issuing this 100 rupee face value at 150 rupees. Okay. So 50 rupees is the premium. 50 rupees is the premium that I'm charging. 50 rupees is the premium that I'm charging. So what is my net proceeds? It is 150 rupees, not 100 rupees. Okay. What is my net profit? Because what is the amount that I'm getting? I'm getting 150 rupees into my bank account, correct? So 150 rupees is my net proceeds. Second question. If flotation cost is given, okay, if flotation cost is given, suppose 1% flotation cost is given. Flotation cost, na cost of raising the money, okay, cost of getting the money. You have to pay some to bankers, you have to pay to consultants, you have to pay to underwriters, okay. This is just a cost. Now there will always be one confusion. This cost I have to apply in face value or issue price. Okay. Unless the question is silent, always this flotation cost is applied at issue price. So you have to reduce 1% flotation cost from the issue price. You have to reduce. So what is 1% of 150 rupees? Okay, what is 1% of 150 rupees? It is 1.5 rupees. So you have to reduce 1.5 rupees. So here the net proceeds will become 148.50. Okay. Okay, what is irredeemable debentures? Why I'm discussing it too much is that because of this point. This is one point where people will be confused. Flotation cost, where you should apply issue price or face value. You should always apply at issue price. Okay. Now irredeemable debentures we have discussed. Irredeemable debentures, nothing. I into 1 minus T divided by NP. Okay. Now, when we talk about redeemable debentures, when we talk about redeemable debentures also what you will pay, interest only you will pay. Okay, I into 1 minus T divided by NP bar, divided by NP. But here what will happen is that, okay, what will happen is that you will pay back the money. Okay, what is a big deal? You're paying back the money. Why will the formula change? Why will the formula change? Because there can be a possibility, correct? There can be a possibility that I took the money, okay? I issued the money at 100 rupees and I redeemed the money at, say, 120 rupees. So this is the redemption value and this is the issue, okay? This is the issue price, okay? This is the issue. So I've issued the amount at 100 rupees and I've redeemed at 120 rupees. The face value is also 100. I'm paying 10% interest. 10 rupees I'm always paying. So 10 rupee in the interest. Assume no taxes. Okay, 10 rupees the interest. So 10 rupee divided by 100, 10%. No, but you're redeeming at 120 rupees, correct? You're redeeming at 120 rupees. This 20 rupees is the premium. This 20 rupees will also become cost, right? This 20 rupees will also become cost. So how to handle this cost? There only what they have to, okay, the difference is 20, correct? This difference is 20. Just treat it as capital gain, okay? The first thing that I'm paying is interest. Second thing, what I'm paying is this premium amount that I'm paying, or maybe the discount. Sometimes it can be reduced at discount also. It can be redeemed at discount also. Usually it is premium only, okay? So I'm taking the example of premium. So this 20 rupees. So, but whenever I say cost of capital is always an annualized percentage, okay? It is always an annualized percentage. So when I talk about this 20 rupees premium, how I should handle this 20 rupees premium, and my debenture is for 5 years. And my debenture is for 5 years. So how I can say this 20 rupees I will amortize over the period of 5 years, which means, okay, this 20 rupees I will amortize over the period of 5 years. So which means 4 rupees every year I will pay. So 10 rupees is the interest, 4 rupee is for the amortization of this capital gain. Okay, approximation method. Okay, this is an approximation method. Don't think this is the actual cost. This is the approximate cost. There are two formulas. I think I'm going a little slow. I think, let me see the time. Ah, 1 hour completed. Okay, so let me, we have to take up this speed because I cannot explain everything. Okay, so the formula is amortization. This will be the interest and this will be the amortization portion. So what is the amortization portion? It will be RV minus NP, redemption value minus NP divided by N. This is the first thing. Okay, this is the first thing. Now you got net proceeds only now, but you have to take the average amount, correct? You have to take the average amount that you have received over the period of years. So NP plus RV divided by 2. Average proceeds, interest portion, capital gain portion. So this will be the formula. This will be the formula. Okay. When we talk about cost of debentures, when we irredeemable debentures, you just have to take the net interest payment. The formula is I into 1 minus T divided by NP. When we talk about redeemable debentures, it is the same formula, but this, redemption value impact should be given. Because premium or discount, this impact should also be given, right? Because it is redeemable, na premium or discount is possible. If it is irredeemable, no premium, no discount is possible. Only one payment interest. So formula is pretty straightforward. So in exam, if question is coming for individual sources, then redeemable debenture will only come. Okay, irredeemable debenture will not come. So RV minus NP divided by N, RV plus NP divided by 2. I is equal to interest payment, NP is equal to net proceeds or market price. Okay, because why market price? If debenture is already issued, now I want to find out the cost. Now I will not take net proceeds. I will take what is the current market price, because usually I have to find the cost of today. The cost of today, and I have to take the market price. So if it is a new issue, I will take net proceeds. If it is an existing issue, I will take market price. Okay. N means remaining life of debentures. If new issue, total life of debentures. If it is an existing issue, remaining life of debentures, then T is the tax rate. T is the tax rate. Okay. I'll tell you one trick. Whenever you're revising any chapter, now suppose I'm revising now cost of capital. What I'm revising? Cost of debt. Okay. Cost of debentures. It is called as KD. It is called as KD. Two formulas are there. Okay. One is irredeemable debentures. What is the formula for irredeemable debentures? I into 1 minus T divided by NP. Second is redeemable debentures. Okay. What is the formula? I into 1 minus T divided by NP. But I have to add RV minus NP divided by N. Divided by N. Many people get confused. Plus bonuma, minus bonuma. See, the concept is you have to take the premium of discount. Okay, RV minus NP premium, the premium will be added as a cost. Discount, the discount will be reduced from the cost. So it will become negative. Okay, it will become negative if it is discount. So, and they have to take the average. So RV plus NP divided by 2. This is the formula. Okay, this is the formula. Now let me take one question. Just for us to just for us to gain some clarity. This is what we are discussing. Okay, this is what we're discussing. Let us take this. Okay, so one thing, let us take this illustration 3. Okay, see, the company issued 10,000 debentures, 10%. Okay, now you know the interest rate is 10%, 100 rupees. This is the face value to be matured at 1/4/2028. Okay, 2018 they issued, it is matured at 2028. But we want to find the cost as on 2023. So from 1/4/2023, when it is maturing to 1/4/2028. So first thing is you have to find out the end. What is the remaining life? Okay, 2023, 24, 25, 26, and then 27, and then 27. So you have 5 years. Okay, 23 to 24, 24 to 25, like this. Okay, 20. So 24, 25, 26, 27, 28. Okay, you have 5 years. N is 5 years. Okay, N is 5 years. So net proceeds, see, actually they have issued, okay, actually they have issued at par 100 rupees. But you should not take 100 rupees as net proceeds, because we are finding the cost today. So you should take the market price of debentures. Even though even though some 3 or 4 years ago, some 5 years ago, they issued at 100 rupees, but today the cost is 80 rupees. So today, if I were to issue, at what price I would have issued? I would have issued at 80 rupees only. So if today cost I want to find out, I have to take all the values for today. So net proceeds is equal to 80. Okay, n is equal to 5, net proceeds is equal to 80. Now, redemption value. Always remember, if nothing is given, always assume that it is redeemed at par. So 100 rupees is the redemption value. 100 rupees is the redemption value. Interest amount. What is the interest amount? What is the interest amount? Interest amount is this 10,000. Interest amount is 10 percentage. 10 percentage on this 100 rupees. So 10 rupees is the interest that I'm paying. Okay. I'm just taking per debenture. Okay. Per debenture cost only. So interest is 10 rupee. What is the tax rate? Tax rate is 35 percentage. Okay. What is the formula? I into 1 minus T plus RV minus NP divided by N. The whole divided by RV plus NP divided by 2. Okay. What is I? I is equal to 10. What is 1 minus T? 1 minus 0.35. Okay. So if you take 10 minus, this 35 percentage, you will get 6.5. Okay. You will get 6.5. So this is there. Okay. Plus, what is RV? 100. What is the current market price? 80. What is the remaining life? 5. The whole divided by 100 plus 80, the whole divided by 2. So it will be 6.5 plus this 100 minus 80 is 20. Okay. 20 divided by 5 is 4. Okay. 6.5 plus 4. The whole divided by 180 divided by 2, which will become 90. Okay. Which will become 90. So 6.5 plus 4 divided by 90, you will get 11.67 percentage. Okay. You will get 11.67 percentage. Typical problem. Okay. Typical problem. So what is the thing that we are doing? Once you know the formula, plug in all the formulas and you will get the answer. Plug in all the formulas and you will get the answers. Okay. Cost of debentures completed. Now debentures, we have two formulas. Okay. Debentures, to find out the cost of debentures, we have two formulas. One is the approximation method, which is the approximate cost. Okay. Approximation method. Another one is conceptual method. Or conceptual method, it is also called as YTM method, or it is also called as IRR. Okay, it is also called as IRR. So one thing is approximation method. Second thing is to finding out the IRR. Now IRR, IRR is one concept that also comes in capital budgeting. So this IRR alone, I will take it in this capital budgeting. Okay, IRR alone, I will take it in capital budgeting. If you know how to calculate IRR, if they have asked in the question, if they're asked is the question, find out the cost of debenture using YTM method. Okay, using YTM method, always calculate the IRR. Okay, always calculate the IRR. What is IRR? IRR is nothing. Okay, IRR is nothing. The rate at which the cash inflows equals the cash outflow. Okay, IRR is nothing. The rate at which the cash inflows equals the cash outflows. You know how to calculate IRR, or if you don't know, I will tell it in this capital budgeting thing. I will tell in this investment decision chapter. So this is the second method, which is IRR. First method is approximation method. Okay, if the question is silent, which method you should use? Which method you should use? It is better to take both. Okay, approximation and IRR method. Usually question will be clear. They will directly tell approximation method, or they will directly tell YTM method. If the question is not clear, okay, if the question is not clear, usually IRR method will come only for irredeemable debentures. So if the question is of redeemable debentures, always use approximation method. Okay, question is giving or not. But if the question is clear, use YTM method, then use YTM. If the question is telling use approximation method, use approximation method. If the question is not clear, an irredeemable debenture is given, okay, Actually, the question is expecting IRR method, but also do approximation method. It will not take much time. Okay, approximation method is 1 minute. IRR method is around some 4 to 5 minutes. Okay, this is only difference. Approximation method is 1 minute, and this is some 4 to 5 minutes, 6 to 7 minutes. Okay, why to take risk? Why to take risk? Always do that. Second one. Okay, cost of debentures we completed. Second is cost of preference shares. Cost of preference shares. It is denoted as KP. Okay, it is denoted as KP. The only difference between the formula in these two is that under interest we will have tax impact, so I will do I into 1 minus t. Under preference dividend I will not have tax impact, so I will not do I minus t. Okay, I into 1 minus t I won't do. But here there is no interest, we will pay dividend. Okay, we'll pay dividend. Here also we have irredeemable preference shares, and here we have redeemable preference shares. Same formula. Okay, it is the same formula. KP is equal to preference dividend 1 minus t. You should not do. Okay, preference dividend into net proceeds, and here it is preference dividend plus, okay, RV minus NP the whole divided by N, the whole divided by RV plus NP divided by 2. This is the formula. 1 minus t alone is ignored. Okay, 1 minus t alone is ignored. Nothing new to discuss in cost of preference share capital. Okay, nothing new to discuss in cost of preference share capital. Now let us come to cost of equity. Let us come to cost of equity. Let me tell you, cost of equity is important. If any individual, okay, if they are asking any individual thing, then cost of equity, there is a high chances that they're going to ask cost of equity only. Cost of equity is denoted as KE. Cost of equity is denoted as KE. Just one moment. Okay. Cost of equity. See, before going into cost of equity, there is one small thing that you should know. So, see, cost of equity, we have total of 5 formulas. We have total of 5 formulas. Okay, 1, 2, 3, 4, and 5. We have total of 5 formulas. One will be the dividend model. Okay, one will be the constant dividend model. Okay, constant dividend. Second will be constant earnings. Third will be the dividend growth model. Okay. Fourth will be the capital asset pricing model, CAPM. So what are those names, sir? If you're hearing this name for the first time, I'm sorry. Okay, I'm sorry. You should have read at least once. If you have read at least once, everything you'd be covered. Different names are used. Okay, this dividend approach is used in the study material. I'm just calling it as constant dividend for memory purposes. Okay. The fifth one is the realized yield approach. Okay. Realized yield approach. For exam perspective, these two are very important. CAPM and dividend growth model, these two are very important for exam perspective. All others are also very simple. Okay, you should not ignore all this. All these formulas very simple, but these are very important. Okay, these are very important. Just 1 minute. Okay. So under cost of equity, we have 5 formulas. Okay, under we have 5 formulas. These 5 formulas are based on 5 different assumptions. Okay, 5 different assumptions. See, you all will be thinking, sir, Anji formula, sir, if 5 formulas are there, then all the formulas should give same answer, na, sir? No. Okay, no, all the formulas will give different answers. Then what is the right formula? Okay, there is no right or wrong in cost of equity. I already in class, I always say that cost of equity, valuing the equity or finding the cost of the equity is a very vague concept. And in this concept, what you have to require is a solid understanding of time value of money. You have to have a solid understanding of time value of money. Once you have that solid understanding of time value of money, cost of equity becomes very easy because it is based on assumptions only. Okay, 5 different formulas, 5 different assumptions, 5 different assumptions, 5 different numbers, 5 different costs. Okay, but nowhere all the formulas will be asked at once. One formula will only be asked. Okay, very simple. Cost of equity, I already said you, cost of capital, this chapter is completely formula oriented. You know the formula. Once you always have to revise. Okay, always take a plain paper, always take a plain paper, write the heading cost of capital. First one, cost of debentures, irredeemable debentures, I into 1 minus t divided by np. Cost of redeemable debentures I into 1 minus t plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. Then cost of preference share, preference dividend divided by NP, cost of redeemable preference shares, like this. Then cost of equity, constant dividend DPS by EPS, constant earnings EPS by MPS, dividend growth model D1 divided by PO plus G. Okay, all these formulas you have to write it in paper for you to not memorize, but at least for you to retain in your brain. Because once it is retained in your brain, it is very easy that it will, you will be able to remember in the exam. In the exam, once you read the question, in the blink of the eyes, okay, or at one chutki, you should get the formula and you should get the answer. That is what is the level of preparation that I'm expecting from you, and that is what is the level of preparation that you should have at this level. And if you're not having at this level, do this practice, whatever I've told you. Take a paper, write down whatever you know, write down whatever you know. Because only if you're writing it down, you're testing your brain. You're testing your brain in exam perspective. You're not writing an exam, but you're testing your brain whether you're able to remember things or not. If you're able to remember things, then you will get a confidence. But if you're not able to remember the thing, then you will open the book and then you will understand. Okay. So that is one thing that I'll push you to do that. Okay, I force you to do that because that is very important. That is very important. Now, cost of equity, I already said we have 5 different formulas. 5 different formulas are having 5 different assumptions. Before going into that, as I said, some time value of money. Okay, some concepts of time value of money. Let me, just tell you. You all know how to calculate the discounted cash flows. How to calculate the discounted cash flows. If you say, no, sir, I don't know how to calculate discounted cash flow, don't worry. Small introduction I'm going to give you now. See, Little theoretical discussion now. If I'm getting, okay, if I'm getting year one, if I'm getting 100 rupees as the cash flow, year two, okay, year two, if I'm getting, say, more 200 rupees as the cash flow, year three, if I'm getting 100 rupees as the cash flow, and I have invested, say, 450 rupees. I've invested, okay? I've invested 450 rupees. So this we always call as year zero, and this is an outflow because investment is an outflow, correct? So investment is an outflow. I will always say, so this is how I will write, okay? This is the notation, which is, this is the way we used to write in financial management. Year zero, 450 outflow. 450 outflow means that you have invested 450 rupees. Year one, year two, year three, positive numbers, it is an inflow, okay? This is how you have to understand. If I'm writing year 0, 450, year 1, year 2, year 3, 100 rupees, 200 rupees, 100 rupees, how you have to understand? Year 0, I had a cash outflow of 450 rupees, which means I've invested 450 rupees. Year 1, year 2, year 3, I got 100 rupees, 200 rupees, and 100 rupees respectively in different years. Now, if somebody is asking, sir, 450 rupees you have invested, okay, 450 rupees you have invested, and 400 rupees you have got, okay, 50 rupees is the loss, sir. It is waste only, na? Okay, pa, it is waste only. Okay, sir, I'm making it 300. Okay, I'm making it 300. Sir, 450 rupees I've invested, and I got 600 rupees, sir. I got 600 rupees. So profit is 150 rupees, correct? You cannot tell, okay, because these cash flows are from different years. You cannot add all these cash flows, because 100 rupees value in year one is not equal to 100 rupee value in year two, is not equal to 100 rupee value in year three, is not equal to 100 rupee value in year zero. So what you have to do, you have to convert this future cash flow, because this 1 2 3 is future cash flow, correct? See, this is certain. Today I'm investing 450 rupees is certain, but tomorrow I will get 100 rupees is uncertain. So this future cash flow, what I will do to add this future cash flow, I have to convert this into present cash flows. Okay. So conversion of future cash flow into present cash flow is called discounting. Okay. I have some amount is year zero, and then I have some amount in year one. If I have to convert this 100 rupees cash flow into year zero, this is what is called as discounting. Okay. Same way, opposite part. Conversion of current cash flow into future cash flow. Okay. Conversion of, okay, present cash flow into future cash flow is called compounding. This compounding you would have already studied in foundation level, and inter level it is not tested very much. Inter level, what it is tested, discounting. Okay, discounting is what is very important. And entire financial management, okay, entire financial management, at least 90% of the financial management is based on the concept of discounting. Discounting occurs because there is a time gap. There is a time gap between the cash flows, and because of this time gap between the cash flows, the value of the money changes. So that is the reason it is called time value of money. It is called time value of money. So if I want to convert this year cash flow, the year one cash flow into year zero cash flow, it is called discounting. How I will discount? Okay, how I will discount is that cash flow, this is the future cash flow that I'm receiving at year one. If I want to discount that, now I have something called as in a rate percentage. Okay, that can be, okay, that can be the rate. There will be something called as discounting rate. At what rate I have to discount? Discounting rate. Suppose the discounting rate is 10%, then it will become 1 plus I. First year cash flow. If it is first year cash flow, now 1 plus I to the power n. If it is second year cash flow, now 1 plus I to the power 2. If it is third year cash flow, now 1 plus I to the power 3. Okay, this is how you discount the first year cash flow, second year cash flow, third year cash flow. Small concept, already you know, just I'm revising. For that. We'll pick up the pace. Now theoretically we have four types of cash flows. Okay, we have four types of cash flows. First is single cash flow. Okay, single cash flow, which means directly what I will tell, year 3 I will receive 400 rupees. Year 3 I will receive 400 rupees. Okay. Always discounting rate is 10%. Let us assume year 3. So if I want to find out the discounted cash flow, how I will find out? How I will find out the discounted cash flow? Two methods. One is the formula method and one is the table method. Usually in exams, we will always use table method. Okay. But I will also tell you the formula method. So as I said, year cash flow. So cash flow 400 divided by 1 plus I. So 1 plus Y is 1.1 and third year cash flow. So it will be 1.1 to the power 3. So what is the answer? The answer is 300 rupees. Okay. So the discounted cash flow for a single cash flow, okay, 400 third year cash flow, it is 300 rupees. It is 300 rupees. Simple, it is very simple. In exam, okay, and you remember this in exam, always write in tables, always write in table. What we are doing is this 400 into this 1.1.1 to the power 3. Now we are taking it separately, and this thing we will call it as present value factor, and this is cash flow, and this is discounted cash flow. So discounted cash flow is equal to cash flow into present value factor. Present value factor at the rate 10% for 3 years. Okay, for 3 years. So if you multiply the cash flow into the 1 divided by 1.1 to the power 3, this 1 divided by 1.1 to the power 3, I will call it as present value factor. If I calculate cash flow into present value factor, I will get the discounted cash flow. Are you all getting confused? Okay. Simple concepts you already know. Maybe I'm telling it in a different way, or maybe I'm telling it in a different language or different words I'm using, but don't get confused. These are just concepts. Why I'm telling these concepts, why I jumped from cost of equity to time value of money, you'll understand in some time. Okay, you'll understand in some time, because this will also be helpful in the investment decision chapter when we are doing NPV, this discounted payback period, and this will also be helpful in the cost of capital chapter. Okay, pa. Lot of time gone. One chapter also not completed. Why we are going very slow? Why we are going very slow is that, uh, you know, I just took some time for theory, and then I'm taking some time for giving a concept. Others directly we can brush up the concept. But let us directly brush up the concept now. Okay, let us directly brush up the concept now. So always remember, it will be year, it will be cash flow, it will be present value factor, and it will be discounted cash flow. What is the year? Third year. What is the cash flow? 400 rupees is the cash flow. Okay. Present value factor at the rate 10%. How you have to find out? Always you have to take the calculator. 1 divided by 1.1. Okay. Equal to na first year cash flow. 2 times equal to na second year. 3 times equal to na, it is always the third year. So it is 0.7513. And if you multiply this with 400, you will get 300 rupees. Okay. You will get 300 rupees. So this is how you have to calculate. Okay. So first is the single cash flow. Second is the multiple cash flows will be given. Okay. Year cash flow, present value factor at the rate 10% and discounted cash flow. Multiple cash flow will be given for different years. Year 1 cash flow, year 2 cash flow, year 3 cash flows will be given. Year 1 you will have 100 rupees. Year 2 you will have 400 rupees. Year 3 you will have suppose 500 rupees. Multiple cash flows are given. How you have to calculate? Same way you have to calculate, and end of the day you have to add. So this will be the discounted cash flows. Okay, this will be the discounted cash flows. So 1 divided by 1.1. Okay, 1 divided by 1.1. Okay, 0.909. Okay, 0.909 or 0.826. Okay, 0.751. You have to multiply this. When you add this, you will get discounted cash flow. Okay, this is the second type of cash flows which will be given. Third type of cash flows are annuity cash flows. Third types of cash flows are annuity cash flows. Annuity cash flows now, every year same amount is there. Okay, every year same amount is there. Suppose they are telling you from 1 to 10 years, from 1 to 10 years, you are receiving 100 rupees. From 1 to 10 years, you are receiving 100 rupees. So what you will do? year cash flow, okay, present value factor, and then discounted cash flow. What few people will be do? They will put 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 cash flow 100, directly put the present value factor and then discounted cash flow. It is very time consuming. It is very consuming. What if I'm writing 100? What if I'm writing 100 years? Okay. So here there is a method which is called as present value annuity factor. Okay. So here what you have to do? So you have to write year 1 to 10. Cash flow is 100 rupees. Present value annuity factor, how you will find out? See, you already know if the cash flow is same, okay, if the cash flow is same, and then you are having present value factor for first year, okay, present value factor for second year, present value factor for third year, and you have to multiply this. What you can do, you can directly put cash flow as common and then present value factor for first year plus present value factor for second year plus present value factor plus third year. This you will do for present value factor for 10 years. When you add this is what I will call as present value annuity factor. So present value annuity factor you can directly find out either from the table or from the calculator. How you have to find out from the calculator? Same thing, 1 divided by 1.1 you have to do. 1 divided by 1.1 you have to do. You have to press 10 times. Okay. One time you have pressed 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 times if you press and then if you do grand total, you will get the present value annuity factor 6.145. Okay. 6.145. This is one method of doing. Grand total is one method of doing. In calculator, second method is there. 1 divided by 1.1. For few people, grand total button will not be there or grand total will not be working properly or don't know how to use it. Then 1 divided by 1. You know, this is the first year. This is the first year present value factor. Put this in M plus. Okay. Put this in M plus. Then second one again put M plus. Third, fourth, fifth, sixth, seventh, eighth, ninth, 10. 10 times you press equal to an M plus, and then if you do MRC na memory recall. If you do MRC, you will get the same amount 6.145. Okay, and then if you calculate, you will get discounted cash flow as 614. So this is the way of calculating the discounted cash flow for annuity cash flow. See, I've jumped into NPV. Okay, I've jumped into NPV. Why NPV? Like you have to find out something called as discounted cash flow. How to calculate discounted cash flow is what we are discussing now. So don't think I'm only taking much time in cost of capital. This cost of capital is I'm discussing, but I'm also taking something from different chapters wherever it is linked. Okay. So annuity cash flows we have discussed. Under this annuity cash flow, we have mid annuity, immediate annuity, but these things usually are not tested in exam. Even if it is tested in exam, very rare chances. Okay. Third one is called as perpetual cash flows. Perpetual cash flows. Now, for example, suppose if I have issued an irredeemable debentures now, I have to pay 10 rupee interest all over the time. Okay, I have to pay 10 rupee interest perpetuity. So that is an example of perpetuity cash flow. It is very important and usually you will be using this. Perpetuity cash flow, how you will write? Here cash flow. Okay. Here you will write 1 to infinity bar because there is an indefinite time. You don't know till what time you will be paying. Suppose the cash flow is 100 rupees. Okay. Suppose the cash flow is 100 rupees. Suppose the cash flow is 100 rupees and interest rate is 10%. So how to find out the discounted cash flow for this type of cash flows? The answer is cash flow divided by I or cash flow divided by R. Okay. This is what is the formula for finding the discounted cash flow for perpetuity cash flow. It is nothing but 100 divided by 10%. You will get 1000 rupees. Okay. 100 divided by 10%, you will get 1000 rupees. So whenever you have to find out the discounted cash flow for perpetuity, the formula is cash flow divided by R. Okay. Cash flow divided by the rate. The cash flow divided by rate, it is 100 divided by 10%, it is 1000. Now, why directly these are asked in questions? Directly these are not asked in questions, but these concepts will be used at different places. Now I will tell you where these are used. Okay, now I'll tell you where these are used. These concepts you have cleared. So now you know how to calculate discounted cash inflows. Okay, discounted cash inflows. If you do discounted cash inflows minus discounted cash outflows, that is what is called as NPV. Again, I'll be discussing in capital budgeting. I'm just giving you a small, revision or a small capsule for investment decision NPV. So NPV, 50-60% discussion we already made. Let us go. Let us go and revise cost of equity. Cost of equity, as I said, 5 formulas. First formula is constant dividend approach. Okay, constant dividend approach. Here what we are assuming is that the company is paying dividend and that dividend is constant, which means year to cash flow 1 to infinity, I'm getting a constant dividend. I'm getting a constant dividend. Okay, I'm getting a constant dividend. You already know any share price, the present value of all the the price of any share is equal to present value of all future cash flows. Present value of all future cash flows is what is called as P0. Okay, is what is called as P0, which means this, if I discount this, I will get P0. So now constant dividend approach, if I want to find out P0 is also called as market price of share. Okay, P0 is also called as market price of share. So now, so K is what I have to find out, correct? K is what I have to find out. I already know the discounted cash flow is equal to P0. Okay, P0 is equal to MPS. MPS is equal to what is the formula? It is dividend per share divided by the cost. Okay, it is the cost of equity. So if I want to find out the cost of equity, then cost of equity will become DPS divided by MPS. Okay, this is one way of understanding. If you're not understanding through this way, forget everything. Forget everything. Formula for constant dividend approach is we are assuming that I'm receiving constant dividend. So that is the reason my formula is DPS divided by MPS. Okay, DPS divided by MPS, or I can also write as dividend per share. It is also called as DMPS. It is also called as P0. Okay, simple thing. Constant dividend approach. Second, constant earnings approach. Constant earnings approach. Nothing. Instead of dividing, what I'm assuming is that entire earnings I'm getting. The cost includes entire earnings that I'm getting. So what is the formula here? EPS divided by market price per share. Okay. KE is equal to EPS divided by market price per share. Okay. EPS also called as MPS. It is also called as P0. Okay. Market price per share, which means the price at zeroth period. Price at zeroth period is market price per share only. Okay. So this is the second formula, constant earnings approach. Third one, dividend growth model. Okay, dividend growth model. Okay, I cannot discuss the logic here, but the formula, okay, but the formula is D1 divided by PO plus G. Here what we are assuming is that the dividend is growing at the rate of G. Okay, the dividend that I'm getting, there was constant dividend. Here the dividend is growing. Growing at what rate? Growing at growth rate. Okay, growing at the growth rate. Suppose my first year dividend is 10 rupee, and if my G is equal to 10 percentage, then my second year dividend will become 11 rupees. Okay, my third year dividend will become 11 plus 10 percentage, it will become 12.1, and this will grow till infinity. So if I want to find out the present value of all these cash flows, this is the formula. First year dividend, okay, not D0. Usually here we were taking the direct dividend, which was D0, okay. But here the first year dividend you have to take. Sir, why first year dividend? What is the logic? Okay, this logic I cannot explain you now, okay, because there is a derivation for this formula, but this logic I cannot explain you now. But you have to understand that first you have to find out the the present value of the dividend, and then you have to add the growth, because here growth is given. So D1 divided by PO plus G. D1 divided by PO plus G. This is the third formula, dividend growth model. Okay. Same way, if someone is asking earnings growth model, directly you write E1 divided by PO plus G. Okay. Earnings growth model, nowhere it is given, but sometime if question is coming, earnings growth model, then you should not get confused. Sir, sixth formula solve illa. Sixth formula I didn't know. So this is just simple common sense. Okay, we don't have to discuss everything, but simple common sense. Now fourth one is capital asset pricing model. Capital asset pricing model, it is also called as CAPM model. Very important. The formula is risk free rate. Okay, the formula is risk free rate plus beta into, okay, RF minus RM. This is what is the formula for. This is what is the formula. Risk-free rate, okay, KE is equal to risk-free rate plus beta into RF minus RM. Now here RF is equal to risk-free rate. Okay. Sometimes instead of risk-free rate, they will also give government yield. Okay, government bond yield. Government bond yield is also treated as risk-free rate. Okay, it is risk-free rate only because government has no risk. Different names will be used. Risk-free rate is also called as government bond. Second is the beta. They can give it as beta coefficient. This is one word that you can use. Or they can use the word as market sensitivity. Okay. Second one, RM. Okay. Second one, RM. RM is the return on market portfolio. Okay. The return from the market is what is called as RM. And RM minus RF also we have a term. RM minus RF also we have a term. It is market risk premium. Sir, what is this? Names and all you're telling. Huh? So now see RF risk-free rate, beta coefficient, no confusions will be there. Where people will get confused is that here. In the question, risk premium will be given. See, I am earning 15 rupees from market. Okay. And risk-free rate is suppose 5%. So by investing in market, I am earning a premium of 10%, correct? This is RM, this is RF. So this is the return on market. This is the risk-free rate. So because I'm investing in stock market, I am getting a premium. I'm getting a premium. This is called as market premium. So if directly in the question market premium 10% is given, so market premium means RM minus RF. Okay. Don't treat this as RM. Don't treat this as RM is what is one important point that you have to see. So whenever the word premium is given, then they are not telling RM. They are actually denoting it to RM minus RF. If return on market portfolio, return on entire market is given, then you have to take it as RM. Then you have to reduce. If you treat this as RM, then you will reduce RF 2 times. Okay, so this thing you don't have to do. This is the only point where people are making mistake. So you should avoid this. Read the question properly. If market premium is given, it is already RM minus RF. Okay. If return on market is given and premium word is not used, then it is RM. Okay. This premium word is what you have to take care. So this is the formula. This is the formula. Now, what is this formula, sir? Okay. See, first thing is risk-free rate. Definitely, I should expect more than risk-free rate because I'm investing in the company. Some premium I will be expecting. Correct. So some premium now first thing is the market premium and RF is what is called as stock sensitivity. The stock sensitivity. I'm just telling you little bit logic, okay, just for you to understand. Market premium into the stock sensitivity. So RF plus beta into RF minus RM is the formula for capital asset pricing model. Okay, capital asset pricing model. Cost of capital is what we are slowly completing. Okay. Next few chapters you will be completing, very fast. Only 2 chapters will take time. One is cost of capital. Cost of capital is actually very simple. Why it is taking time? Because here, a lot of formulas are there. People get confused a lot. And this is one of the easiest chapter, trust me. See the formula, risk-free rate. Okay. Risk-free rate is 10%. Risk-free rate is 10%. Beta, okay. Beta is equal to 1.75. Return on market portfolio. Nowhere premium word is given. So RM is equal to 15%. So what is the formula? K is equal to risk-free rate plus beta into RM minus RF. Okay, what is risk-free rate? 10%. What is beta? 1.7%, 1.75. What is RM? RM is 15%. RF is 10%. Correct. So 10% plus 15 minus 10, 5%. Okay, 5% into 1.75. Okay, 5% into 1.75 is equal to 8.75%. Okay, 8.75%. So 10 plus 8.75% will become 18.75%. So here if you see, the K is equal to 18.75%. Very simple. Okay, very simple. Nowhere no complications are there. Nowhere no complications will be there. Same thing, let me just take this growth model, if anything is given. Now, one question it is usually asked is, what formula we should use if it is not given in the question? See, based on the information, if dividend information is given, growth information is not given, use constant dividend approach. Okay, use constant dividend, because that is what you can use. Correct. If dividend information is given, growth information is also given, use dividend growth model. Okay, use dividend growth model. Okay, if information of dividend is not given, information of earnings is given, use constant earnings model. If growth is also given, then use the earnings growth model. Okay, if somewhere beta is given, RF is given, because that is very simple, I don't have to tell, then use CAPM model. So these are all the models that you can use. These are all the models that you can use. Next one, and the last one is cost of retained earnings. Okay, cost of retained earnings. Cost of retained earnings is generally, okay, cost of retained earnings is denoted as KR, is generally equal to KE. Okay, is usually cost of retained earnings is equal to KE, is equal to KE, unless, okay, unless we have a few more adjustments. Only the one formula that I can tell you, is that cost of retained earnings is equal to cost of equity. But if any transaction price is there, okay, if any transaction price is there, then this one minus this transaction price is what you have to, or flotation cost. Okay, flotation cost is that, then you have to reduce, because retail earnings now you are not issuing equity, now you are issuing. So retail earnings means you are saving some amount on flotation cost, so you have to reduce it from cost of equity. You have to reduce it from cost of equity. Personal income tax, because if it is equity, now you'll pay dividend, and from the on the dividend the person will be paying personal income tax. But retail earnings now, it is, you're not paying anything, you're not paying it as dividend, so then you'll be saving on personal income tax also. Corporate income tax, don't take it. Okay, if personal income tax information is given, then it will be 1 minus personal income tax. Okay, personal taxes. Okay, personal taxes, or brokerage is given, then 1 minus brokerage. Okay, 1 minus brokerage. Okay, so flotation cost 2% is given. If personal income tax, some 10% is there. Okay, 10% the tax rate on dividend. If brokerage, some 1% is there. Okay, and if cost of dividend is given as say 25%, then what you have to do, you have to do 25% into 1 minus 0.02. Okay, into 1 minus 0.1 into 1 minus 0.01. You have to do this. Okay, you have to do this, which is 25 minus 2%. Then you have to do 25 minus 2%. Then you have to do minus 10%. So all these things you have to do, and only then you will be getting the correct answer. Okay, 1 minus 0.02 will become 0.98. Okay, into this you will get 0.90, into this will get 0.99. Okay, 25%. So 25 into 0.98 into 0.90 into 0.99, you will get the answer as 21.83%. So this is the answer. See, one 3-mark problem once they have asked in this question, only on the simple point. Only on the simple point. If you don't know this point, okay, three informations were given. Cost of equity of the company is this, but the rate of flotation was this percentage, personal income tax was this percentage, brokerage was this percentage. Okay, what is the cost of retained earnings? Simple. This is the cost of retained earnings. Usually cost of retained earnings is equal to cost of equity, but if some additional information is given, only then this adjustment have to be made. So This is the now we have discussed all the cost and all the formulas. Okay, now using all these formulas, you will find the overall cost of capital. Overall cost of capital, that is also called as weighted average cost of capital. Okay, WACC. That is also called as weighted average cost of capital, that is WACC. Okay, now how to calculate this WACC? We'll take a small 10 to 15 minutes break, just small 10 to 15 minutes water break or snacks break, and then we will take up. Yeah, okay, so Kavin, we are taking a break for 10 to 15 minutes, and then we'll go to continue. So we'll meet at 11 o'clock. Okay, so we'll continue with cost of capital. Cost of capital is almost completed. Only one more discussion is pending, which is nothing but weighted average cost of capital. And weighted average cost of capital is consolidation of whatever we have discussed. So when we found out the individual cost of capital, weighted average cost of capital is nothing but assigning some weights and then multiplying the individual cost of capital to find something called as WACC. Weighted average cost of capital, also people call it as WACC or overall cost of capital. Okay, let me share my screen. Okay, last part of this chapter, which is overall cost of capital, also called as weighted average cost of capital. Okay, also called as weighted average cost of capital. So once you found out all the individual cash flows, okay, individual cost of capital, always remember weighted average cost of capital. You always do it in a table format, okay? And I'll tell you how to write it in the exams. First, you write it sources, okay? Sources. Suppose it is equity share capital, okay? Equity share capital, okay? Then you have preference share capital. Then suppose you have this debentures, okay? Debentures. Now write down what is the amount. Suppose I'm having, 200 crores, okay? 200 crores of equity share capital, 100 crores of preference share capital, 300 crores of have total debentures. So, okay, 200 crores. 200 crores of total debentures. So now I have total 500 crores is the amount that I'm totally having. Okay. This is what you do. Okay. This is what you will have it. Okay. This is what the information that you will have it. Now you will find out the cost also. Cost already know some using some any KE formula you will use. Suppose the cost of equity is 30 percentage. Okay. Suppose the cost of preferential capital is 20 percentage. Suppose the cost of debenture is 15 percentage. Okay. You all find out the cost using the formulas that you have used. Now what you have to do, you have to find out the weight. You have to find out the weight. Now how to calculate the weight? Okay, this divided by this is the weight. You can either write it in percentage or you can either write it in ratios. Okay, anyway, you have to multiply this. Then you will get something called as weighted average cost of capital. If you total this, okay, you will get a weighted average cost of capital. Okay, this is weighted costs. Okay, this is weighted costs. If you add all this, you will get weighted average cost of capital. Now 200 divided by 500, okay, 200 divided by 500, what is the amount? It is either you can write it as 0.40, okay, both ways possible, or you can also write it as 40 percentage. Anyhow, 40 percentage is to 30 percentage, or 0.4 into 0.3, anyhow you will get something as 12 percentage. Okay, so 30 percentage, okay, 30 percentage into 0.4, okay, you will get 12, you will get 12 percentage. And then 100 divided by this is 20, 0.20. Okay, now 20 into 0.2 is equal to 4. Okay, 20 into 0.2 is equal to 4. Then this will again become 0.4. Always this will be 1. You know, anyhow I'm taking weight only. So 0.4 into, so 15 into 0.4. What is the amount that I'm getting? I'm getting the amount of 6. So my weighted average cost of capital is 22 percentage. My weighted average cost of capital is 22 percentage. This is how you will calculate the weighted average cost of capital. Nothing new we have discussed. This is what is the overall table that you have to find out. Whenever any question comes of weighted average cost of capital, you have to use this table: sources, amount, weight, cost, weighted cost. The total is weighted average cost of capital. This weighted average cost of capital is what they will be asked. Now, second one, this weight is there, right? In weighted average cost of capital, you have two methods. This weight you can either put as book value weights. You have two types of weight WACC. One is book value weights, another one is market value weights. Okay, book value weights and then market value weights. Book value weight is very easy. Book value weight, suppose you're having equity share capital, okay, retained earnings, which is also called as reserves and surplus. Okay, reserves and surplus. And suppose you're having preference share capital, suppose you're having debentures, whatever is the amount that is given in the in the balance sheet. Okay, whatever is amount which is given in balance sheet is what is called as book value weights, now second, when we talk about market value weights, what, sir? Okay, you have to put market value, whatever is given in the market value. But here always a confusion will be there. Equity share capital, suppose I'm telling my market price per share is 40 rupees, and suppose I'm having 1 lakh shares, so 40 lakh rupees. Now 40 lakh rupees, is it equity share capital or reserves and surplus? How we have to do? How we have to do is what the question that always will be asked. So always in market value, there will be no bifurcation between equity share capital and reserves and surplus. It will be equity share capital plus reserves and surplus. This will be the market price of the share. This will be the market price, because we are putting market price. So market price of the share. This is the market value. On this market value only you have to calculate the weight. And second one will be the preference share capital. What is the current right now? What is the market price of my preference share? Then debentures. Right now, what is the market price? What is the market price? What is the market price? But many a times we have to bifurcate it into equity share capital and reserves. So you have to bifurcate in the ratio of the book value of equity share capital and reserves. So if a bifurcation is there between equity share capital and reserves, two approaches are used in textbook. One, they will not do any bifurcation. Directly, they will write it as equity. They don't write equity share capital. They directly write it as equity, and then they'll put it as market price of share capital, market price of share. Or the second, what they will do is equity share capital and reserves and surplus, both they will put. And suppose if I'm having 40 lakh rupees, this will be bifurcated in the ratio of the book value. Suppose here this is 50 and this is 100. It is in the ratio of 1:2, so they will bifurcate in the ratio of 1:2. Okay, so this is these are the two ways of doing. Here many people get confused why bifurcation is that. So this is the explanation of this book value weights and market value weights. So if you see the questions, okay, let me see the questions. Very simple questions will be there. Okay, there is nothing tough whenever we are calculating anything in cost of capital. Now, if you see this question, you have to calculate the WACC using book value weights and market value weights. Book value will be very easy. This will be this directly will be the book value. 5 lakh, 5 lakh and 10 lakh. Okay. If you see here, this will be the book value. Book value weights 5 lakh, 5 lakh and 10 lakh. How to calculate after tax cost of capital? You already know. Okay. You already know. Here cost of equity dividend growth model is used. D1 divided by D1 divided by PO. See, flotation cost. I always say price left flotation cost should also be reduced plus G. Okay, this is one mistake that people will do. Flotation cost is there now. It will always be reduced from the net proceeds. So here the net proceeds is the market price of the share. So this is the cost of equity. Here cost of debt. So here cost of debt they did using YTM approach. Okay, they did using YTM approach. As you said, it is given in the question YTM approach. What is YTM approach? YTM approach is nothing but the IRR method. What is IRR method? First find two NPVs. First find two NPVs. One, the NPV will be negative. Another, the NPV will be positive. Then using interpolation, find a rate where the NPV is equal to 0. That is what is called as IRR. What is the formula for interpolation? This is the formula, NPV at lower rate plus. So all these we are going to discuss in capital budgeting or investment decision chapter. But I hope you already know how to calculate IRR. If not, we are going to discuss that because I don't want to include everything here. Okay. So this is the cost of debt. Cost of preference shares also you have to calculate. This also they have calculated using IRR method. And then now when it comes to market value weights, see directly what they have given equity shares. because here reserves and surplus bifurcation is not there. So they take the market value 24 rupees, 110 rupees, 105 rupees. So market value will be given in the question. Okay, 105, 110, 24 into how many numbers of shares are there. They calculate 5,000, 5,000, and then you will get the market value. Based on the market value, you will find out the WACC. So this is the concept. This is the concept. So with this, see, marginal cost of capital is again very simple. Marginal cost of capital is nothing, cost of raising additional finance. Additional finance, now till now this was the cost. Now if I want to raise this finance, this will be my cost. So what is my overall cost of capital is what is called as marginal cost of capital. Very simple. Once you see the book and see the problems, it will be very easy. You just have to find out the additional cost for what is the cost for raising additional finance is what you are going to do. So this is what is this is the total chapter of cost of capital. Now cost of capital we have completed. Cost of capital we have completed. Let us go into the second chapter. Very easy, very straightforward chapter. Okay, within 15 to 20 minutes we can complete this chapter. What, 15 to 20 minutes? You took almost 2 hours for first chapter. See, first chapter are always concept building. Okay, first 2 chapters we completed, the theory part and then the cost of capital part. Now we are going to do the next chapter, which is called as leverages. Okay, leverages. Under leverages, okay, under leverages, only 2 types of problems are possible. Okay, under leverages, only 2 types of problems are possible. First thing will be information will be given. Information will be given, either part information or full information, and they will ask to calculate, to compute the leverages or to find the leverages. Okay, find the leverages. All the leverages they'll ask you to find out. Find operating leverage, find financial leverage, find combined leverage. So this is one type of problem which is possible. Second type of problem, few information, okay, few leverages will be given, few leverages will be given, and they will ask you to construct the income sheet. Okay, this is the second type of problem which is usually asked in leverages. Okay, here find leverages and also some additional questions. Okay, also some additional questions based on leverages. Okay, so these are the only 2 types of problems are possible in leverages. Usually when I say this will usually be coupled with this ratio analysis in planning, this ratio analysis chapter. Leverages are usually asked in combination with ratio analysis. Ratio analysis, few information will be given. Based on this few information, some leverages will also be given, and they will ask you to construct the income sheet, or maybe they will ask you some other information. Okay, so leverages is very straightforward chapter, completely formula based chapter. But here formula also you don't need to mug up. Okay, formula also we have very easy text to remember. Okay, because people get confused. First thing is you should know how to make an income statement. You should know how to make an income statement. Okay, so first thing is income statement. What is income statement? Sales minus variable cost. What is sales minus variable cost? It is contribution. Okay, it is contribution. Then contribution minus fixed cost. Contribution minus fixed cost is equal to EBIT. Then minus interest. You will get something called as earnings before tax. Okay, earnings before tax. And then you will reduce taxes. You will get earnings after tax, or also called as profit after tax. This is the usual income statement. Or additionally, if preference dividend is there, okay, if preference dividend is there, okay, 10 out of 9, the question ends here. Okay, only 5% of the time preference dividend will also be given in the question. So minus preference dividend you have to do, and then you will have something called as earnings available to equity shareholders. Okay, this is rare scenario. So this is the normal income statement. So first thing is you have to remember the income statement. And income statement you don't have to remember. It is very straightforward. Sales less variable cost, you will get contribution, less fixed cost. Okay, less fixed cost. You will get EBIT. Then less interest, you will get EBT. Then less taxes, you will get profit after taxes. Less taxes, you will get profit after taxes. Okay, now leverages occurs only because of fixed cost. Okay, leverages occurs only because of fixed cost. Now if you see in this income statement, you have two fixed cost. One is this fixed cost. This is one fixed cost that you have to pay, because irrespective what is fixed cost, any cost which is paid irrespective of the volume of the company, which means any cost which is paid irrespective of the sales of the company is what is called as fixed cost. The second fixed cost you will see is interest, because whatever be the sales, interest amount will be same, correct? So here we have two fixed costs. Here we have two fixed costs. This is called as operating fixed cost. Okay, this is called as financial fixed cost. Okay, leverages occurs because of the because of fixed cost. If there is no fixed cost, then leverages will not be there. Okay, if there is no fixed cost, then leverages will not be there. Don't tell leverages zero. Leverages will not be there. There is no leverage at all. Only because of fixed cost leverages occurs. So this is one understanding that you should be having. Okay, now contribution. Okay, now contribution divided by EBIT. Okay, contribution divided by EBIT is called operating leverage. Okay, contribution divided by EBIT is called operating leverage. Okay, you don't have to remember, because of fixed cost there is a leverage which is that you're having. So contribution divided by EBIT is operating leverage. EBIT divided by EBT is called financial leverage. This what is the formula? Somebody is asking you what is the formula for operating leverage. It is contribution divided by EBIT. Okay, this arrow. If somebody is asking you what is the formula for financial leverage, it is EBIT divided by EBT. Okay, it is EBIT divided by EBT. Preference dividend I am not discussing now. Otherwise, preference dividend is also a fixed cost, but preference dividend I am not discussing now. Okay, we'll discuss it in the last. But for now, so you don't have to remember this formula. Okay, now what is combined leverage? Combined leverage, now what is the leverage which is occurring because of both this fixed cost? So both this fixed cost now, contribution divided by EBT, this is the combined leverage. No need to remember the formula, just visualize the income statement. Contribution divided by EBIT, operating leverage. EBIT divided by EBT is financial leverage. Contribution divided by EBT is equal to combined leverage. Combined leverage now, operating leverage into financial leverage. Okay, operating leverage into financial leverage is what is combined leverage. Okay, because combined leverage is the combined, what is the leverage that I'm having because of the combined fixed cost. So both this fixed cost I have to take into consideration. So contribution divided by EBIT, operating leverage, EBIT divided by EBT, financial leverage, contribution divided by EBT will become the combined A contribution divided by EBT will become my combined leverage. Okay, will become my combined leverage. Now, this is one formula. Okay, this is one formula. Now we have another set of formula, which is percentage change formula. You don't have to mug up anything. Because of fixed cost only things are happening. Okay, because of fixed cost only things are happening. Now earnings after tax, if you divide it by number of shares, okay, if you divide it by number of shares, you will get EPS. Okay, you divide it by number of shares, you will get EPS. Okay, you will get the amount as EPS. So this is the total income statement. Sales minus variable cost contribution minus fixed cost EBIT minus interest EBT minus taxes will become profit after tax. Profit after tax, this is the profit after tax which is available to equity shareholders. So divided by, assuming no preference dividend, divided by number of equity shareholders, I will get earnings per share. Okay, I will get earnings per share. Suppose 10 crore is my total profit, and suppose I'm having 1 crore shares. So per share profit, per share earning, so earning per share is 10 rupees. Okay, this is how it is done. So this is the first formula, which is the number formula. Okay, which is the number formula. Second also, actually I can do it here also, but it will become little clumsy. Okay, it will become little clumsy. Let me make again. Okay, sales minus variable cost. Okay, it is contribution minus fixed cost. I will have EBIT. Okay, minus interest, I will have earnings before tax, minus taxes, I will have earnings after tax, divided by number of shares, I am having EPS. Okay, I'm having EPS. I'm having EPS. Second formula, okay, second formula is, and you know that this is happening because of fixed cost only. This is one fixed cost and this is one fixed cost. Okay. Now the second formula is, we are connecting 2 points. Okay, we are connecting 2 points. Here it will go upward. Okay, because of this fixed cost. So it is percentage change in EBIT divided by percentage change in sales. Okay, operating leverage is equal to percentage change in EBIT divided by, now it is going this way. Okay, it is percentage change in sales. See, we have a proper derivation of this formula, but this is just an easy way of understanding. Okay, this is just an easy way of understanding. So percentage change in EBIT divided by percentage change in sales. Then it will come in that way, and it will start from contribution. Here we are connecting sales and EBIT. So this is second formula. One is the number formula. Second is this percentage change formula. Second is this percentage change formula. Second one, it will come from here. Okay, start to end, we are just connecting the starting point and ending points. EPS and the start it will come to EBIT. So the second formula for financial leverage is equal to percentage change in EPS divided by percentage change in EBIT. Okay, percentage change in EBIT. Percentage change in EBIT. Third combined leverage formula, what it will come from? Okay, it will come from here to here. The combined leverage formula is equal to percentage change in EPS divided by percentage change in sales. Okay, percentage change in EPS divided by percentage change in sales. If at all you want to remember, okay, if at all you want to remember this, always remember this formula by having this number 3. Okay, by having this number 3. First formula 3 comes like this. Second form, okay, first formula, it will come like this. Third formula, I mean, it will come like this. Okay. The second formula, it will go like this. Okay. The second formula is bigger. So you just have to remember this number 3. Always make an income statement. Okay. These two are the fixed cost. So first formula is very simple. Second formula, okay, this is how you have to remember. This is how you have to remember. This is just a small trick of remembering, because many a times, even when I was writing the exam, many a times I used to forget percentage change in EPS numerator varnuma, negative then denominator varnuma, percentage change in EBIT numerator varnuma, denominator. So these things are very confusing. So just to remove these confusions, always have a small any trick in your mind. Okay. So this is the trick in your mind. The second formula, connect the first and the second. So first formula, it is up to down. Okay. First formula, it is top to bottom. Okay. Top to bottom. Second formula, it is bottom to top. No need to confuse anything, just a way. If you already know the formula, no worries. But if you don't know the formula, this is the way that you can remember the formulas. So total 6 formulas. And also that combined leverage is equal to operating leverage into financial leverage. So total 7 formulas. Okay, you understood now. 7 formulas, you understood now. If you know these 7 formulas, this chapter is completed. If you know these 7 formulas, this chapter is completed. Nothing more is there in this. Okay, nothing more is there in this. But few points are there. Okay, few points are there. Few approaches are there. Few tricks and tactics are there to solve the problem that I will tell you now. But till now, you should have a clarity. Till now, you should have a clarity. Leverages, formulas are important. We have 3 types of leverages: operating leverage, financial leverage, and combined leverage. Operating leverage have the impact of the operating fixed cost. Financial leverage have the impact of the financial fixed cost. Combined leverage take both the fixed cost impact into that. Okay, takes both the fixed cost impact. Now just we have to, as I said, always take a plain paper and write the formula. Okay, operating leverage, what is the formula? You have to visualize and tell what operating leverage, what is the formula. It is contribution divided by EBIT. Okay, operating leverage, financial leverage, and combined leverage. Here, what is the formula? Earnings before tax divided by EBIT. Okay, here, what is the formula? Contribution divided by earnings before tax. Okay, contribution divided by earnings before tax. This is what is the formula, correct? Contribution divided by EBIT, then EBT divided by EBIT, then contribution divided by EBT. Okay, this is the first formula. Now, what is the second formula? Operating leverage, from bottom to top it will come. So it will connect EBIT with sales. Okay, it will connect EBIT with sales. So percentage change in EBIT divided by percentage change in sales. Now here also financial leverage from bottom. Bottom, what is there? EPS is there. So it will connect from bottom to top. So percentage change in EPS divided by where it will connect? EBIT it will connect. So percentage change in EBIT. Okay, percentage change in EBIT. Third one, bottom to top. So EPS is connected with sales. Okay, or you can also multiply these both, operating leverage into financial leverage. So change in percentage change in EPS divided by percentage change in sales. Next formula, our combined leverage is equal to operating leverage into financial leverage. Total 7 formulas is what we have discussed. Leverages is nothing but this 7 formulas. Okay, 7 formulas. Leverages is almost completed. Okay, 90% leverages is almost completed. Okay. Now, recently we had few more additions, few more points here and there in leverages. That is what we are going to discuss now. So usually this is what is the leverages. Okay, this is what is the leverages. But here few points leverages will be there. Always remember, okay, always remember, you all know this formula, correct? In costing, you all know this formula. Margin of safety is equal to this EBIT divided by contribution. EBIT divided by contribution. So operating leverage is equal to contribution divided by EBIT. If margin of safety is equal to EBIT divided by contribution, which means they both are inverse. So operating leverage I can also call it as 1 divided by margin of safety. This is one point where few people get confused. This is one point where few people get confused. If margin of safety is given in the question, they will do all sort of formulas instead of directly finding out. If directly someone is giving you that that margin of safety is, if margin of safety is some amount, then directly you can find out the operating leverage divided. You can directly do it by 1 divided by margin of safety. Okay, 1 divided by margin of safety. Directly you can find out. If someone is telling you margin of safety is 4, if someone is telling you if the margin of safety is 4, then operating leverage is equal to 1 divided by 4, which is 0.25. Directly you can find out 0.25. Then from 0.25 you can put 0.25 is equal to contribution divided by EBIT, and you can find out all the missing values. Okay. This leverages chapter is all about fill in the blanks. Okay, few values will be given, few values will not be given. The values which is given you have to identify, the value which is not given you have to calculate using all this, fill in the blanks, putting values here and there, plugging here and there, moving the values from here and there, and finding the value. So this is one formula. Okay, contribution divided by EBIT, or 1 divided by margin of safety. Okay, 1 divided by margin of safety. Correct. Now, this is what we understood. This is what we understood now. Now, calculation part we know. Calculation part we know. What about the interpretation part? Okay, what about the interpretation part? Interpretation is nothing but if I'm telling my operating leverage, okay, if I'm telling that my operating leverage is 2 times. Okay, if I'm telling my operating leverage is 2 times. So as you know, operating leverage connects the sales and EBIT. What it connects? Sales and EBIT. So I can tell 1% increase in sales will have 2% increase in EBIT. This is what is the interpretation that you have to make. If someone is telling you that my percentage change in sales is 1% and percentage change, then if my operating leverage is 2 times, then my EBIT will change 2 times. That is where, what is percentage change in EBIT? 2%. What is percentage change in sales? 1%. So what is my operating leverage? It is 2 times. Okay, this is how it is interpreted. Okay, this is how it is interpreted. Always it is inverse. If they are telling, if your sales is decreased, okay, so if there is a 1% decrease in sales, then there will also be a 1% decrease in EBIT. Same thing if it is financial leverage. If they are telling my financial leverage is 3 times, okay, which means 1% increase in EBIT, because it connects EBIT and EPS. So 1% increase in EBIT will have 3 times this impact. So 3 will have 3% increase in EPS. So if my profit, my EBIT is increasing by 1%, now my EPS will increase by 3%. So 3 times it will increase. Okay. If 2%, that's 3 times it will increase. So 6% it will increase. This is how it goes. So that is why, what is my percentage change in EPS? 3. What is my percentage in EBIT? So that is where it will come as 3 times. Okay. Same goes for combined leverage. So this is how you interpret the numbers. So suppose if the problem is given, my sales was 10,000. Now my sales is increased to 12,000 rupees. What will be my new EBIT? If they are asking this now, don't again, prepare the Don't again prepare the income statement. Directly see what is the increase in sales. Increase in sales 10,000 to 12,000. It is 20%. If the operating leverage is 2 times now, my EBIT will increase by 40%. So see old EBIT do into 1.4. So plus 40%, and this will be my new EBIT because my EBIT is increasing. This is how you have to calculate. Okay, this is how you have to calculate. Let me do one problem. Okay, let me do one problem. I won't do a big problem. One small problem we will do just for you to get some clarity. Okay, leverage is one small problem we will do. Leverages. See, very simple problem. Sales given, variable cost given, fixed cost given. From this, okay, interest amount is given. Borrowed 10 lakh, 10% is the interest rate. Number of shares you can calculate. 10 lakh is the share capital, 100 rupees each. So there are 10,000 shares. You can directly, calculate the income statement. Very simple, right? Sales less variable cost, contribution less fixed cost, EBIT less interest, EBT less tax, earnings after tax divided by number of equity shares, you will get EPS. Okay. Now what they have asked, operating leverage, financial leverage, combined leverage. Operating leverage, financial leverage, combined leverage. What is operating leverage? What is operating leverage? Contribution divided by EBIT. Okay. So contribution divided by EBIT. So which means 12 lakhs divided by 2 lakhs. It is 6 times. Okay. It is 6 times. Correct. What is financial leverage? To EBIT divided by EBT. So 2 lakh divided by 1 lakh. It is 2 times. Okay. So my operating leverage is 6 times. Very simple. See, I'm doing it very simply, but in exam you have to write operating leverage is equal to, first you have to make this income statement, calculation of income statement, do this income statement, right? Operating leverage is equal to contribution by EBIT, so is equal to 12 lakh divided by 2 lakh is equal to 6 times. Financial leverage is equal to 2 times. Combined leverage is equal to operating leverage into financial leverage is equal to 6 into 2 is equal to 12 times. Simple. Now, if you see, if sale is increasing by 6 lakh, what is my new EBIT? Okay. If sale is increasing by 6 lakh, what is my new EBIT? So first see what is the percentage change in sales. Okay. First see what is the percentage change in sales, which means 6 lakhs divided by 24 lakhs. So there is a 25% increase in sales. If sale increasing by 6 lakh, now first you calculate into percentage. So 25% increase in sales. What is my percentage increase in EBIT? Is what you have to find out. Now, what is something that connects sales with EBIT? What is something that connects sales with EBIT? What is something that connects sales with EBIT? Sales with EBIT, operating leverage is connecting, correct? What is operating leverage? 6. Okay. What is the formula for operating leverage? Percentage change in EBIT. Okay. Percentage change in EBIT divided by percentage change in sales, correct? What is my percentage change in sales? 25%, correct? So 6 is equal to percentage change in EBIT, okay, into this percentage change in sales will come here. What is my percentage change in sales? It is 25%, correct? It is 25%. So my percentage, my new EBIT should be 150%, correct? My new EBIT should be 150%. Okay. Which means that I can say if my sale is increasing by 25%, my EBIT should increase by 150%. Correct. My EBIT should increase by 150%. Now, what was my EBIT? What was my old EBIT? Okay, what was my old EBIT? My old EBIT was 2 lakh rupees. Okay, my old EBIT was 2 lakh rupees. Now 2 lakh, I have to increase it by 150%. So which means I can do into 150 divided by 1.5. Okay, 150%. I have to increase it by 150%. So 1.5 means it will become, okay, 150% I have to increase. So this plus 2 lakhs, I have to increase it by 150%. 2 lakhs into 150 divided by 100, which is 1.5. Okay, which is 1.5. So 2 lakh into 1.5 is equal to 3 lakhs. Okay, 2 lakh into 1.5 is equal to 3 lakh. So I have to increase 2 lakh by 3 lakh. So I will get the new EBIT as 5 lakh rupees. I will get the new EBIT as 5 lakh rupees. Okay. What is my increase in EBIT? It is 2 lakh. So my new EBIT is equal to 5 lakh rupees. Very simple, right? Very simple. Nothing is there. Okay. See, return on investment is nothing. Return on investment is nothing. It is what is the return that you're earning. Investment amount is not given. So I think they are doing profit after tax divided by sales. What is the profit after tax? It is the net profit percentage, correct? But here, okay, investment they are asking. It is not net profit, it is investment. So what is the total investment? They are having a total investment of 10 lakh and 10 lakh in debt and 10 lakh in equity. So 20 lakh rupees. Okay. So 50,000 divided by 20 lakh rupees. 50,000 divided by 20 lakh rupees is, okay, 50,000 divided by 20 lakh rupees is equal to 2.5%. But this is return on investment for equity. Okay, return on investment for equity. So you only have to take equity. So 50,000 divided by 10 lakh into 100 is what they have given as 5%. Okay, this is return on investment. So you can take total return on investment also. Okay, both the assumptions are possible. First, you can take the total investment. Total investment is equal to equity plus debt. So that you will get at 2.5%. If you have to find out the total return on only equity shareholders, then ROE. Okay, ROE, return on equity shareholders, is equal to PAT divided by equity shareholders. Okay, equity shareholders amount. If it is total return on equity, so return on total capital. Okay, the return on total investment is equal to, okay, return on total investment, if you want to find out, then it will be PAT divided by this long-term loan. Okay, which means debentures plus equity shareholders. Okay, both the answers are possible. So this is one type of questions which can come. Okay, same thing. See, all the things are given: equity share capital, bonds, PV ratio. From this PV ratio, you can calculate contribution, correct? Sales into PV ratio is equal to contribution. Okay, then sales, contribution less fixed cost, EBIT less interest less other fixed interest, because I think here fixed cost is directly given. Fixed cost is directly given excluding interest. Okay, so all these amount you have to calculate, and from this you will get PAT. So different types of problems you have to solve to get an understanding. Otherwise, everything is similar and everything is same. Okay, once you know these formulas, you'll be able to equally handle all the questions. Okay, equally able to handle all the questions. Done. Now, one point that I had to discuss: what will happen if preference dividend is given? Okay, what will happen if preference dividend is given? You already know the formula for operating leverage, financial leverage, and combined leverage. What is the formula for operating leverage? It is contribution. Okay, it is contribution divided by EBIT. You can also write it as, okay, you can also write it as contribution divided by contribution minus fixed cost. It is always numerator divided by, it is always numerator divided by numerator minus fixed cost. Okay, here it is EBIT divided by EBT. You can also write as EBIT divided by EBIT minus interest, because interest is one fixed cost. Okay, combined leverage is equal to contribution divided by EBIT. So it is contribution divided by contribution minus fixed cost minus interest. Nothing I did. Okay, nothing I did. Now whenever preference dividend is coming, because preference dividend is a financial, so this formula, no change will be there. Okay, this is the same formula. But whenever preference dividend is coming, this financial leverage formula will change, because here now we have two interests. Okay, one is the preference dividend. Preference dividend is also fixed cost, and interest is also fixed cost. So you have to reduce preference dividend also here. Okay, you have to reduce in combined leverage also, you have to reduce preference dividend also here. Okay, you have to reduce preference dividend also here. But what mistakes that many people do is that this preference dividend is an after tax item, and all these were the before tax item. So here tax adjustment should be made. So preference dividend divided by 1 minus t, preference dividend 1 divided by 1 minus t. This preference dividend after tax item, you have to bring it into before tax, because all these are before tax item, correct? Preference dividend will alone come under after tax. So this alone you have to do, this adjustment alone you have to do. Okay, so whenever preference dividend is there, your formula for financial leverage will change. EBIT divided by EBT minus preference dividend divided by 1 minus T. Why I put minus interest? Just to understand, just to make you understand the concept that two fixed costs we have to reduce. Okay, two fixed cost is what we are reducing. Okay, interest and preference dividend, but preference dividend, one tax adjustment alone we have to make. Okay, one RTP problem they gave, many students did wrong. Okay, many students, 90% of the students did wrong. So this is one adjustment that you have to make. With this, we completed this chapter of leverages. With this, we completed this chapter of leverages. Nothing more is there in leverages. This is what is the entire chapter for leverages. Just solve few problems so that you will get comfort in the solving the problems. Okay. Concepts, I also told you how to remember all the formulas. Okay, remembering the formula, I also told you the trick. If this trick will be there, see, you all know the formula, but in exam time, because of time pressure, people tend to make silly mistakes. To avoid silly mistakes, we have to use some tactics, okay, during preparation stage. So this is what I was sharing with you. Now we are coming into the third one, which is capital structure. This is the underestimated chapter, underrated chapter. Few people don't give so much importance to this chapter, but one of the easiest chapter and very scoring. Okay, very scoring. Even I as a student used to ignore this chapter because I thought it is very easy, but without practice you will not be able to do this capital structure. So just a quick revision of capital structure. So just a quick revision of capital structure. Capital structure. Here, what are the types of problems which are possible? Why I'm giving you types of problem is that first thing is you should have an understanding in this chapter what we are going to do. I'm not giving you the agenda. I'm giving you what are the types of problem that are asked in exams. It is because it is exam oriented. If it is agenda, I will give you the topics. I'm not giving you the topics. I'm giving you what are the types of question which can be asked in question. First type of question which is asked in question is that, do EBIT and EPS MPS analysis, okay, to find which capital structure is better. To find which capital structure is better. Which capital structure is better. I'm always giving this in the order of importance, okay, in the order of importance. The second which can be asked is the indifference point. The indifference point, okay, indifference point. Also, one financial break-even also you can include, okay, financial break-even point. Financial break-even. Many people get confused, but we will study this also, okay. Indifference point, financial break-even. The third questions which will be asked, it will be in capital structure theories, it will be asked, okay, in capital structure theories it will be asked. Capital structure theories is again very underrated. In capital structure also, this net income and net operating income is alone is very important. We have one more approach which is called as Modigliani-Miller. Very rarely it is seen in the exams. Okay, net income approach and net operating income approach is important. And indifference point is very simple. You study or not study, it is very simple. Okay, but this is also many times very scoring. These are the only three types of problems which can be asked in capital structure. Nothing more than that is there in capital structure. Okay. See, we completed cost of capital, we completed leverages. Now we are into capital structure theories. And we also completed the first chapter. Out of total 10 chapters, 3 chapters we completed. There is one theory chapter, types of financing. I would suggest you to read it because there is nothing more value addition I can make to that. Okay. So 3 chapters completed. Now we are into capital structure theories. 3 types of problems are there. Okay, 3 types of problems are there. So we'll start capital structure theories. We'll just take a small 5-minute break. Okay, small 5-minute break, and then we'll just start off. Okay. Okay, students. So, okay. See, since it's a live class, since it's a live streaming, it's a live class. I just wanted to know how many of you are actually, listening to this. Please, type yes. Please type yes or something that I'll get to know that okay, you all are with me and you all are understanding. So please type, yes in the comment. I'm just seeing this so that I'll get to know that at least people are listening and people are Hmm, understanding things. And if you have any doubts also, you can type it. I'll take it up because I have the YouTube live with me. So can you just type yes if you're actually listening to me and you're understanding whatever I'm telling. Even if you're not understanding, type something. So at least I'll get to know. So I'll have a feel that, okay, we are having a live session here. Mm, anyone, can you please type something so that 1 minute, I'll just open it. So I just saw one message of Nageshwar. Okay, so fine. So we'll continue with capital structure. Okay, very good. I got one message. Okay, fine, done. So see, I hope this class will be very useful. One, even if you have not studied something, because of this class, you will get to know something. And there is always a FOMO that we will have. What we will miss some concepts. What if we miss some chapters? So to reduce this FOMO, that is the objective of the batch, that the objective of this class, that you have to reduce this FOMO, that you should not have this FOMO that what if something I missed, or what if I'm not able to solve this, or what if this chapter I didn't do. So you should have a thorough picture of what you're doing and a thorough understanding of what you're doing. So right now we can't go very conceptually, but still I'm trying hard, to explain it, the formulas also, and also, logic wherever it is there. Okay. But actually it is not feasible for me to discuss all the logics, but let's see how time goes. So if time is going properly, we will, do, otherwise we have to, rush through in the end. So I hope till now things are going well and it is, very good, very good. Okay. So I'm starting receiving messages. Very good. Okay, fine. So let us continue. Let us continue with capital structure. Capital structure. Now, capital structure, I already told you that we have three types of problems which are possible. One is this EBIT, EPS, MPS analysis, which is actually whenever in the question it is given which capital structure is getter, or find the optimum capital structure. Okay, find the optimum capital structure. Okay, so this is one type of question. Second one is they will ask you find out the indifference point, and third one using the capital structure theory. So using NI theory, using NOI theory, find out the value. Find out the value. So that is the three types of problems which are possible in capital structures. Okay, capital structure. Now let us do the first one. Let us do the first one. Okay. Okay, everything is very simple. Everything is very simple. And if you have any doubt, please message me in the YouTube, or in the YouTube I'll take up the doubts. So if not, I'll in the end I'll give you my number so you can reach out to me. Okay, because student is facing any difficulty, please reach out to me. I'll do my best, to address all your queries. Now, first one is EBIT, EPS, MPS analysis, or also called as calculation. Okay, also called as choosing or calculation, like choosing optimum capital structure. Okay, choosing optimum capital structure. Always remember, whenever this type of problem comes, choosing optimum capital structure, always remember optimum capital structure means where EPS is maximum or MPS is maximum. Okay, if information is given, you can calculate MPS. Usually EPS, MPS information will not be given. That is the reason I wrote EBIT, EPS, MPS. If information is given, you find out the market price per share. See, capital structure means what? How many percentage debt you should have, how many percentage equity shares you should have, how many percentage preference shares you should have, in what proportion you should have. Suppose you have three options. One is 15% equity, 10% debt, and 40% preference share capital. Another one is 100% equity. Another one is 10% debt, 90% preference share, and no debt. Okay, so these are the three alternatives possible. Now what you have to do, using all these three alternatives, find out the EPS, because ultimately the capital structure where the shareholder is beneficial, my equity shareholders wealth is maximum. Now what is the wealth of the equity shareholder? EPS. If information is there, then MPS. So this is what is the choosing optimum capital structure. EPS is maximum or MPS is maximum. That is what is the optimum capital structure. This is the concept. Now how to do? Whenever any problem comes, always see how many options. If there are three options, okay, then do option one or alternate option one, option two, option three. Okay, three option will be there. Write or what option is there? What option is there? You can write it down. Either it is 10%. So you write out what is the option. Okay, what is the option? You write out what option. Okay, write out what option. Then you have to start with EBIT. Okay, you have to start with EBIT. EBIT you have to start. Usually it will be same, or if some information is given based on the information. Okay, EBIT. EBIT less interest. What you will get? EBT. EBT less tax. What you will get? This is nothing. Income statement only. Half income statement. Okay. EBT minus taxes. What you will get? You will get earnings after tax. Here usually preference dividend will be there. Okay, there preference dividend rarely will be there. Here usually preference dividend will be there. So minus preference dividend. Now what you will get? Now you will get earnings available to equity shareholders. So earnings available to equity shareholders you will get. Okay, this is the earnings available to equity shareholders. Now you have to divide number of equity shareholders. Okay, number of equity shareholders. Once you divide the number of equity shareholders, you will get the EPS. Okay, now suppose say here your EPS is 10, here your EPS is 12, and here your EPS is 9. Then you have to say optimum capital structure is option 2. Okay, this is how it is calculated. Now, how to calculate the market price per share? How to calculate the market price per share? See, if P ratio is given, okay, you all know that PE is equal to MPS divided by EPS, correct? PE is equal to MPS divided by EPS. If you don't know it now, okay? PE ratio is equal to MPS divided by EPS. See, what is PE ratio? Means for my earnings of 1 rupee, how much the market is pricing my share. Suppose my P ratio is 3 times now. If I'm earning 1 rupee, people are willing to pay 3 rupee for my shares. Correct? If I'm earning 10 rupee, people are willing to pay 30 rupees for my shares. So EPS into PE ratio is equal to MPS. Okay. Suppose my PE ratio is say 5 times. Okay. Suppose my PE ratio is say 5 times. then my market share per share will be 50, then here it will be 60, then here it will be 45. But at many places in option 2 your PE ratio will become 3. So like this information will be given. That is the reason you have to check on the basis of market price per share also. Okay, in it is given because where debt will be higher, PE ratio will be lower at many places. So that is the reason here they will tell here the PE ratio is here the PE ratio is 4 and here the PE ratio is say 4. So now this will become 50, this will become 48, and this will become 9 into 4 is equal to 36. So now if you see, option A is becoming better. So EBIT, EPS and MPS analysis, usually 90% of the time the question stops at EPS, but if P ratio is given, then you have to calculate MPS also. Okay, then you have to calculate MPS also. Okay. And yeah, one more thing. 1 by P ratio is equal to K. You already know that. So suppose if K is given, okay, suppose if K is given, then you do 1 by K is equal to P ratio, and then you do EPS into P, okay, to find out the MPS. This is one more information. Suppose P ratio is not given, but K is given. With K, you can find out P ratio. From P ratio, you can do EPS into P ratio is equal to MPS. Okay. Whatever types of problems are possible, I'm trying to discuss it in as much simple manner as possible. Now it is up to you how you're taking it and how you're remembering it. Okay, fine. So first type of problem, and 50 to 60% of the time this problem only comes. If this problem comes now, free 5 to 6 marks. Okay, free 5 to 6 marks. Nothing you have to do. Income statement you have to do. Based on income statement, optimum capital structure alone you have to calculate. Okay. So in the end, you have to choose the optimum capital structure is the structure where EPS or MPS is maximum. So here the EPS is maximum in option 2. That is the reason option 2 is preferable. What is option 2? You have to write say this much preference share, this much equity share. This is the best alternative. This is the best optimum capital structure. Like this, you have to frame this answer in the end. For framing this answer in the end, you will get 1 mark. Okay, don't forget. Just doing this and circling this will not do the work. You have to frame the answer. Okay, you have to frame this answer. Okay, first type of problem done. Second, indifference point. Second is indifference point. So let me see if any messages are there so I can address. Okay, fine. Okay, so indifference point. So when we are seeing indifference point means level of EBIT. Okay, level of EBIT where, okay, what is indifference point? You always have to see level of EBIT where the EPS level, where the alternatives, where both the options, okay, where both the options have same EPS, where both options have same EPS. Now here indifference point usually will be done only between option 1 and 2 only, okay. If you're having 3 options, then you have to find out 3 indifference point, 1, 2, 2, 3 and 1, 3. Like that also one question is there. Option 1, option 2. Okay, option 1, option 2. See, there EBIT will be given, but here in this question EBIT will not be given. EBIT only you have to find out. That is what is the indifference point. Now what EBIT you have to find out where EPS is same. Where EPS is same. That is what is called as indifference point. Okay, nothing more, nothing less. That is what is indifference point. Many people get confused seeing the formula. Sir, what is this formula, sir? EBIT minus interest, okay, minus into 1 minus D minus preference dividend divided by N is equal to EBIT minus I2. This is one formula which is given in the textbook. So when we see this formula, we will have a headache. But you have to understand this, that this formula is made directly from the income statement only. Directly from the income statement only. See, EBIT, you don't know. So you can put directly EBIT or you can put X also. Okay. Either you put X because the level of EBIT where it is same. Either you put X or you put EBIT. Okay. Not an issue. Now minus interest. interest will be given. So you do minus interest. Okay. Suppose say interest here is 1000, and suppose here interest is 1500. Just an example I'm taking. Okay. Now EBIT minus interest, what is there? EBIT, earnings before interest and tax. You will get earnings before tax. What is earnings before tax? X minus 1000. Here it is X minus 1500. Okay. Here it is X minus 1500. Now tax rates. Okay. Now tax rates. Now minus tax. Suppose tax is 50%. Okay. Suppose tax is 50%. So you have to multiply this with 50%. Correct. You have to multiply this with 50%. So what will be EBT? What will be EBT? This into 1 minus t. Correct. This into 1 minus t. That is again EBT. So X minus 1000. Okay. X minus 1000 into 1 minus t. Correct. Here also X minus 1500 into 1 minus t. Correct. So if you put 50% into 1 minus t, which means into 0.05, and this also into 0.5, not 0.05, 0.5 and 0.5. Okay. 0.5 is 50%. Correct. Now you have to divide number of shares. Divide number of shares. Okay. Suppose here the number of shares is 1000, and suppose here 1000 number of shares is 1500 rupees. Okay. Now what will happen? X minus 1000, X minus 1000. 1 minute. X minus 1000. 1 minute. So here you will have X minus 1000 into 1 minus 0.5, the whole divided by 1000. Here you will have X minus 1500 into 1 minus 0.5, the whole divided by 1500. Okay. The whole divided by 1500. Now you want the EBIT level where EPS is same. Correct. So just equate this. Okay. Just equate this. Now what you will have? X minus 1000 into 1 by 0.05. The whole divided by 1000 is equal to X minus 1500 into 1 minus 0.5, the whole divided by 1500. Okay. Then you do all this cross multiplication and you will get some value, that is EBIT. Okay. That is EBIT. This is one way of doing the problem. Okay. This is also acceptable in exam. Put EBIT as X and do this. Okay. Then you will also have preference dividend here. So preference dividend also you have to minus. Okay. Preference dividend also you have to minus. So suppose here preference dividend is there, here it is not there, then that also you have to minus. Okay. Earnings before tax, this is profit after tax. Okay. So this also you have to minus. The same way, from this only a formula has been created. Now this is nothing new. Okay. Nothing new. It is nothing but EBIT. Okay. Minus I1. That is the interest that you're having. Into, okay, into 1 minus P. Okay. Minus preference dividend. The whole divided by number of shares in first. The whole divided by number of shares in plus. Okay. Now second way you have to equate this to EBIT minus I2 into 1 minus T. Okay. Minus preference dividend, the whole divided by N2, number of shares N2. We just equate all this. This is just a formula approach, and that is just the table approach. Okay. Usually it is logical to do table approach, but formula approach little less time. Formula will take little less time, table will take little more time, but how you are understanding, you have to do. The only thing is you should avoid silly mistakes. The only thing is you should avoid silly mistakes. Now this is completed. This is what is indifference point for. This is what is indifference point. Okay. Now let me show you some problem. Why I'm showing you some problem is that you will get an comfort that whatever we are studying is actually there. Okay. I'm not telling something out of the world. It is actually there, and it has been asked in exam multiple times. Okay. Indifference point. Okay. So first is this EBIT, EPS, NPS analysis. You can see. See, this is a question. This is a question. Firm has an all equity capital structure having 1 lakh ordinary shares. Now they want to raise 2,50,000 as loan. Now they want to raise, they're already having 1 lakh shares. Now they want to raise 2,50,000. They are having three options. First option is total equity you issue. Second option is you borrow at 8% rate. Third option is you take preference shares at 8%. Okay, three options are there. Now they have given the firm's EBIT, the firm's earnings before interest and tax after the additional investment at 3,12,500. Okay, so after the additional investment, I am having 3,12,500. Tax rate is 50%. Okay, tax rate is 50%. See, take the EBIT. Here interest will be there. Okay, here interest will be there. Here preference dividend will be there. So here there is no interest, no preferred dividend because it is completely equity financing. You will find out EPS. Here EPS is maximum. So directly you have to, choose option number 2. If you see, you have to choose option number 2. The firm is able to when it is using debt financing. When it is using debt financing. Okay. When it is using debt financing. Now here, suppose if P ratio is given, then you multiply P ratio, calculate MPS, and wherever MPS is maximum, you have to choose it. This is what is one question. But here, there is one more complication which can be there is that, under EBIT, EPS and MPS analysis, just one moment. Okay. So one problem that we can face under EBIT, EPS and MPS analysis is that this is only one issue. Already they will be having a capital structure. Okay, already they will be having some equity. They'll be having some debt. Okay, suppose they're having 1 crore equity, 2 crore debt, and they are raising at suppose 10% is the interest rate. Now they want to raise additionally they want to have some 100 crore rupees, and they're having three options. Okay, first is 100% equity. Okay, second one is 50% equity and 50% debt. I mean 50 crores and 50 crore debt. But here the interest rate is say 12%. Okay, here the interest rate is 12%. Third is have a preference share capital at an interest rate of at a preference dividend of 8%. Now here you will have an EBIT. Here you will have old EBIT and new EBIT. First you will have old EBIT. Now with this they were earning say 50 lakh rupees they were earning. Now because of this their EBIT will increase to say 2 crore rupees. So now 2 crore rupees will be the EBIT. Okay, to 2 crore, 2 crore, 2 crore will be EBIT. So when you have to minus interest, you have to minus both the interest, correct? Because this is total EBIT. So you have to interest total interest. So interest on old, okay? You have to see interest on old debentures and then interest on new debentures. So old debentures at all the three places interest will come, but new debentures because it is all equity, no interest will come. Here interest will come, here interest will not come. Okay. Same way you have to calculate EBIT minus interest, you will get earnings before tax. Okay, then minus taxes you will get, then profit after tax you will have. Okay, then minus preference dividend will be there, minus preference dividend, here preference dividend will be there. Then you will have something called as earnings available to equity shareholders. Now again, take note, you have to reduce number of equity shares. Okay, number of equity shares. Already they were having some equity shares, correct? So old shares, old number of shares. Many people do this mistake, old number of shares and new number of shares. Okay, new shares. Now here they are issuing old shares, it will be there, and new shares because here it is all equity, so here new shares will be there. Okay, here no shares will be there because it is completely preference shares, so no shares will be there, and here 50% is the equity, so 50% share will be there. Okay, so this is one thing. Once you do this, you will get the actual EPS S. Okay, you will get the actual EPS, and wherever the EPS is maximum, you have to take. See, this is one advanced issue. Okay, this is one advanced issue. Only when you solve the problem, you will get to know this complexities. Okay, only when you solve the problem, you will get to know this complexities. I'll tell you which problem. There are a few problem like this. I'll tell you which problem I'm talking about. See this problem. See, once you see this problem, EBIT is there. Okay. Here, debt on existing debt and on new debt, two interest you have to reduce. Okay. And number of shares. This is how few problems will be where you don't have to, miss, or you don't have to take a chance. Okay. Done. So we completed indifference point. Okay. Indifference point also I will show you a problem. Why I'm showing you problem is that you should be comfortable. Actually, that is your job to see all the problems, because in this less time we will not be having time to discuss the problems. But let us see two plans are there. Under plan 1, this is the interest. Plan 2, this is the interest. Directly see, if there is no preference dividend, they will formulate it. EBIT minus I1 into 1 minus t divided by E1. E1 is the number of equity shares in first, number of equity shares in second. Formulate it, equate it, find out the EBIT. This EBIT is called the indifference point. Okay, this EBIT is called the indifference point. Then this is what is EBIT. Now the third one, many people are not aware also, and many people leave this also. Financial break even. Financial break even point. Okay, financial break even point is nothing but the total fixed costs. Okay, total fixed cost. Because it is financial fixed cost, so it is nothing but interest. Or if preference dividend is that, then preference dividend. This is what is financial break even point. Now why I'm telling interest plus preference dividend, because if I earn only to the extent of interest, then my EPS will become zero. What is financial break even point? The EBIT level at where the EPS is zero. The EBIT level where EPS is zero. Now, where EPS will be zero? EPS will be zero if I'm actually having the EBIT of 10 rupees and my interest is also 10 rupees. Okay, then my EPS will become zero. Correct. Because I'll be having no taxes, then my interest will become zero. So my financial break-even point is equal to interest plus preference dividend. If preference dividend, then preference dividend. So interest plus preference dividend, but preference dividend is 1 minus T. Okay, because it is before tax number. So preference dividend is 1 minus T. So this is what is financial break-even point. This is what is financial break-even point. So if in the question it is asked what is financial break-even point, don't be scared. It is nothing. Interest is done. Interest preference dividend done. Interest plus preference dividend divided by 1 minus T. Financial break-even completed. Now to choose the optimum capital structure. Okay, now to choose the optimum capital structure, if you have three choices. Okay, if you have three choices. Now two choices now you already know. Two choices now you already know. If you have three choices and how to choose and what to choose, there is always a rule. Okay, there is always a rule. I will not be telling you the logic of this rule, but there is this rule. One problem is there. Okay, one problem is there, but I'm going to discuss this. I'm going to discuss this. Now, what is the rule is that if your EBIT is less than indifference point. Okay, if your EBIT is less than indifference point. Okay, here if your EBIT is equal to indifference point. Here if your EBIT is more than indifference point. Also, if you have two options, which plan to choose? Okay, my EBIT is less than indifference point. Should I choose plan A or plan B? What should I choose? Okay, what should I choose? See, if it is EBIT is equal to indifference point, choose any plan. Okay, choose any plan. Plan A, na plan or alternative or option. Okay, choose any option. Choose any plan or choose any option. Okay, if EBIT is equal to indifference point. If EBIT is less than indifference point, then choose the plan. Okay, then choose the plan where financial leverage is low. Now here, choose the plan where financial leverage is high, which means you have to find out the financial leverage, and wherever the financial leverage is high, you have to choose the plan. If EB8 is more than IDP, then choose where financial leverage is high. If EB8 is less than IDP, then choose where financial leverage is low. Only one question is there in the study material in this way. That also we discussed here. Okay, that also we discussed here. Done. So this is just the choice of action, which plan to choose. From indifference plan, how to see from optimum capital structure, you know where EPS is maximum, I will choose, where MPS is maximum, I will choose. But from indifference point, how will I take a decision? From indifference point, this is how you will take a decision. Decision from indifference point. Okay, decision from indifference point. Usually in the question, they will ask you to find out the indifference point. They will not ask you to take the decision. But if decision is asked to take, then you have to see if EB8 is less than indifference point, then choose the plan where financial leverage is low. If EB8 is more than indifference point, then choose the plan where financial leverage is high. Okay, choose the plan where financial leverage is high. See, directly if you're telling my EB, suppose my indifference point is 10 lakhs. Now they will give you, now my EB80 was 8 lakh, my EB80 was 12 lakh. Okay, here my financial, if my EB80 is less than IDP and my financial leverage is low, okay, so in two options, my financial leverage is low in one, so I will choose option 1 here and I will choose option 2 here. Here 1 or 2. Okay, here 1 or 2. Okay, so capital structure theories, now 80% of the chapter is completed. Okay, capital structure theories la these two, EB80, EPS, MPS analysis and indifference point, financial break-even point. Okay, these two are 80%. Okay, 80% of the chance these two will come, or 20% of the chance, or very easy. Okay, but if even if it is coming very easy, 4 marks, very easy 4-mark question will be coming from capital structure theories. Okay, capital structure theories. Capital structure theory, see, understanding capital structure theories is very difficult, but solving problem is very easy. Even a 6th standard student can solve, but because it is very easy, we tend to leave, and because we leave, we will not remember. Because we will not remember, we will not solve. Okay, so that's how people lose mark. So this is the underrated topic, or underestimated topic. Now, capital structure theories. When I talk about capital structure theories, 3 formulas alone you have to remember. 3 formulas alone you have to remember. If you remember these 3 formulas, any problem, if it is coming, you'll be able to solve. Okay. First one, capital structure theory is actually the objective is to find the value. Okay, to find the value of the company. But here firm is, here they don't tell company, financial management, they won't tell company, they tell firm. So you have to find out the value of the firm. Okay. So one formula is value of the firm is equal to value of the firm is equal to value of equity plus value of debt. Okay, value of the firm is equal to value of equity plus value of debt. Correct only now. What is my value of equity plus value of debt? If I add this, that is my consolidated value of the firm. This is one formula. Sir, this doesn't even count in the formula, but I'm counting this in the formula also. Okay, now we have other things. Okay, value of the firm is equal to value of debt plus value of equity. Okay, value of debt plus value of equity. See, what is value of debt? What is value of debt? Hmm? You all know, that value of debt is equal to I divided by KD. Correct. See, capital structure theories, always we will make 2 assumptions. Because I know you will ask a question. Sir, I into 1 minus T dana pannu. I into 1 minus T, that is only my net proceeds. Why I? So here we have always 2 assumptions. Don't get confused here. One assumption is we have only 2 sources of finance. We have 2 sources of finance. Equity and debt. Otherwise, you will ask a question, where is preference shares? Okay, only 2 sources of finance, equity and debt. Second assumption, what we are making is no taxes. So these things are happening in a world where there is no taxes. Okay, sir, happy. Let us go into that world. Afterwards, we'll go after exams. Okay, now let us focus. Assumptions, 2 assumptions we are making. First one, we have 2 sources of finance, equity and debt. Second thing is no taxes. Okay, so that is the reason it is I divided by KD. See, suppose I'm having 10 lakh rupees of loan, okay, and my interest percentage is 10%. My interest percentage is 10%. So what is my interest amount? It is 1 lakh. So if I want to find out the value of this loan, value of the loan is nothing. This 10 lakh is the value of the loan. But how will I calculate? I'm just formulating it. I divided by KD. Okay. My KD is 10%. My interest is 1 lakh. So I divided by KD is value of the debt. Okay. I divided by KD is value of debt. Done. It is nothing but interest is the cash flow available to debt holders divided by their cost is what is called as value. Okay. This is the cash flow available to capital provider. Okay. Under numerator, it will come cash flow available to capital provider, the whole divided by cost to capital provider. Okay. Cost of capital provider. Just logical understanding. Okay. Don't write this in exam, just logical understanding. So interest divided by KD. Now value of equity, what is the amount which is available to equity shareholders? EBIT, but under from EBIT interest will be gone. Interest we have to give. Okay. From interest taxes will be gone. Sir, we don't have any taxes. Okay. From taxes we'll have PAT. From there preference dividend will be there. We don't have any preference dividend. So EBIT minus interest is only earnings available to equity shareholders. Okay. Now this is the amount available to equity shareholders. What is the cost of equity? KE. So EBIT minus I divided by KE is equal to value of equity. Okay. So value of firm is equal to value of equity plus value of debt. Value of equity is equal to EBIT minus I the whole divided by KE. Okay, EBIT minus I the whole divided by KE. Value of debt is equal to interest divided by KD. Okay, interest divided by KD. Okay. Now, one thing I think I missed to tell you, this WACC or overall cost of capital is also called as K0. Okay, it is denoted as K0. You already know, okay, but I missed to tell at that point in time. Okay, now value of equity, value of debt. Value of equity is EBIT minus I. See, why EBIT minus I already told you. The sir, earnings available to equity shareholders is EBIT minus I is EBT. Then we have to do minus taxes. Then we have to do minus preference dividend. See, no taxes, no preference dividend. So that is the reason EBIT minus I divided by K. Okay, this is the formula. What is value of firm? What is value of firm? Value of firm na total. So what is total? Total is EBIT. This is earnings available to both equity and debt holders. Okay, yeah, this is the earnings available to both equity and debt holders divided by cost to both. What is the cost to both? KO is the cost to both. KO means the combined cost of KE and KD. So KO means the cost to both. So value of firm is equal to EBIT divided by KO. Value of equity is equal to EBIT minus I divided by KE. Value of debt is equal to I divided by KD. This is the only formula that you have to remember. And I asked you to remember, but actually I explained you. Okay. So logically you all know, but this is the formula that you have to remember now. Okay. Value of the firm, value of equity, value of debt. Okay. Now, once you remember this formula, now we are going to see two approaches. One is net income approach. Okay, that is also called as NI approach. One is net operating income approach. Net operating income approach. That is NOI. Okay, net income approach and net operating income approach. Two line alone you remember. Okay. Under net income approach, KE is constant. Under net operating income approach, KO is constant. Okay. Why I'm telling this is because here it is, when we call about theories, now they call it, this is a relevance theory. Okay, this is a relevance theory and this is an irrelevance theory. I won't go much deep, okay, because not very important, but I'm just telling, suppose if any theory is asked, this is a relevance theory, this is an irrelevance theory. Relevance theory now, according to net income approach, capital structure is relevant in taking capital structure decisions. Because of capital structure, your value of the firm will change. But under net operating income approach, your value of firm will not change. So here value of firm will change. Okay, here will change. Here value of firm will not change. Will not change. Okay. This is the main line that you have to remember. Under net income approach, KE is constant. Under net operating income approach, KO is constant. Okay. Under net operating income approach, KO is constant. Now, whenever any question is asked, okay, whenever any question is asked in, okay, in, and if it is written that net income approach, whenever any question is asked, and if it is written net income approach, what you have to do is that first you do EBIT, okay, minus interest. What you will get? Earnings available to equity shareholders only I will get, okay. Earnings available to equity shareholders you will get. Now, earnings available to equity shareholders you will get. Now, KE will be given in the question. So divide KE, okay. Say KE is 15%, divide KE. If you divide KE, what you will get? Value of equity you will get, correct. Net income approach, first you find out the value of equity. Value of equity you will get, correct. Yes, no. If value of equity you are getting, then you find out the value of debt. Value of debt is nothing but I divided by KD, and then find out value of the firm is nothing but value of equity plus value of debt. So if somebody is asking find out the value of the firm using net income approach, this is how you will do. Okay, this is how you will do. Net income approach, this is how you will do. Okay. Now, if somebody is asking you find out the value of the firm using net operating income approach, okay, using net operating income approach, usually, okay, usually you already know, right? Here first you have to write the line value of the firm is equal to value of equity plus value of debt. Here also value of the firm is equal to value of equity plus value of debt. Here first, okay, here you have to calculate value of equity. Okay, here you have to calculate value of equity, and then you have to, from there you have to bring it to the value of firm. But here if KO is given in the question, directly you can put value of the firm is equal to EBIT divided by KO. Okay, EBIT divided by KO, you will get the value of the firm. Okay, then you have to find out value of the debt. From there you will find out value of equity. Value of debt you will get from value of the firm, you reduce value of the debt, you will get value of the equity. You will get value of equity, and from there you can find out KE. Okay, from there you can find out KE, because EBIT divided by value of equity is equal to KE. So here KE you can find out, and here KO you can find out. Okay, here KO you can find out. Here KO you can find out. What is KO? EBIT divided by value of the firm. Nothing but value of the firm is equal to EBIT divided by KO. So KO is equal to EBIT divided by value of the firm. Here KE you can find out. What is KE? EBIT divided by value of equity. See, net income approach and net operating income approach, no difference is there. Here value of the firm you will calculate in the last year, value of the firm you will calculate in the, and here KO is what you will calculate in the end, here K is what you will calculate in the end. As I said, one sentence alone you have to remember. Under net income approach, KE is constant. Okay, under net income approach, KE is constant. So KE will be there and KO is what you will find out. Under net operating income approach, KO is constant. So KO will already be there and K is what you have to find out. Value of the firm you can find out. Okay, here value of the firm EBIT divided by KO, and here value of the firm you have to arrive it from value of equity. Okay, because K is constant, first you can find out value of equity, then value of equity plus value of debt is equal to value of the firm. Here because KO is there, directly you can find out the value of the firm. Done. See, this is what is the capital structure phase. I know you all will be getting little confused. What is this, sir? K is constant, KO is constant. But once you see the question, you'll be able to visualize what I'm telling. Just see any one question and see. I'll tell you one question. Only when we see the question, now we will get comfort while solving the problems. Now see, this is what they will ask. KE is given, correct? If K is given, now you have to understand that this is net income approach. Okay, you don't have to ask the question again and again. It is net income approach. It is net income approach. So EBIT is given, then EBIT minus interest, find out the equity available to earnings available to equity shareholders. Divide this by 60%, 16%, find out the equity, value of equity. From value of equity, okay, from value of equity, you add market value of debt, you will find out the total value of the firm. And then overall cost of capital, you can find out. It is nothing but the EBIT divided by value of the firm. Done. This is the first approach. See second one. Second one also, firm's equity capitalization is given. So again, it is net income approach only. Now here see, overall cost of capital, KO is given. So it is net operating income approach. So directly you can find out the KE. Okay, what is EBIT? 5 lakhs divided by 50% value of the firm. Was second answer, you got it. Okay, value of the firm is equal to 5 lakh divided by 15%, which is nothing but 33 lakh 33,000. Okay, 33 lakh 33,333. Now what is the cost of equity? Cost of equity you can find out, correct? If you have the value of the firm, find out the value of the equity, you reduce it, you will get the market value of equity. Then from the value of the equity, because you know value of the firm, you can directly find out the cost of equity also. Done. Once you see this problem, you will be able to understand. Okay, once you see this problem, okay, forget all this, always do it in table approach. Okay, whenever table and formulas are given, only you know the concept, only then you go into formula approach. Otherwise, you will end up confusing yourself. Okay, done. Capital structure theories is completed. Okay, capital structure theories is completed. Now miscellaneous point, few miscellaneous points. Otherwise, you should not tell, sir didn't tell this, otherwise we missed some 4 to 5 marks. There is one more approach, which is traditional approach. Okay, traditional approach is nothing. Sir, nothing. Now why questions are asked? Because you leave it because saying that it is nothing. Okay, see, under traditional method, you already know that cost of debt will always be same, cost of equity is constant, cost of this KO is constant in this approaches. But here under traditional method, many options will be there, 1 2 3 4 5, many options will be there. You will be having KD, they will be giving cost of debt for different. Suppose it is 5%, 10%, 15%, 12%, 13%, 14%. Okay, cost of debt will be given. Okay, suppose cost of equity is given. Okay, suppose weight of one thing is given. Suppose say percentage of debt is given or percentage of equity is given. Weight, suppose weight of debt is given. So I am having 50% equity here. Debt equity ratio also they can say. So debt equity ratio, suppose I'm 50%, I'm having 60% here, I'm having 30% here. Okay, now what you have to do, you have to find out the second weight. Second weight is balancing figure, 50%, 40%, 70%. You have to find out the KO. Traditional approach is nothing but the approach where KO is maximum. The capital structure where KO is maximum is what is called as traditional approach. So what is KO? KO is nothing but weighted average cost of capital, correct? You have two sources. One is equity and one is debt. Suppose you're having equity of 100 rupees and debt of 50 rupees. So if you do, this is 1 by 3 and this is, okay, this is 2 by 3 and this is 1 by 3, correct? So this is what is the weight. This is what is the debt equity ratio. So what you're doing is that you're calculating weight 1 into cost. Suppose this is cost is 30% and this cost is 15%. Okay, this cost is 15%. So what you're doing nothing but weight 1. Okay, this is weight and this is cost. So weight 1 into KE plus weight 2 into KD. This is what is the formula. So suppose if it is given, KD is given, K is given, weight is given, calculate weight 2 and then find out KO, and wherever KO is maximum, that is what is the answer. Okay, I'll show you one traditional approach. This, now see, this is the traditional approach. This is traditional approach. Cost of debt is given, cost of equity is given. Percentage of debt percentage of debt is given. So what you have to find out? Percentage of equity find out. Okay. So this will be the weight 1, this will be the weight 2. Okay. Now here 0% debt, now it is 100% equity. This is weight. Okay, weight. So here it will become 0.9, 0.8, 0.7, 0.6, 0.5, 0.4. Now cost of debt into weight of debt plus cost of equity into weight of equity is equal to KO. KO is nothing but this into this plus this into this. This will be the KO. Once you multiply all the KOs, okay, multiply all the KOs, wherever the KO is maximum. If you see, second option is best because, okay, sorry. Capital structure, wherever cost is minimum, okay, I just got confused here. Wherever KO is minimum is what you have to choose. It is cost, correct? So minimum cost alone you have to choose. Sorry for this misunderstanding. Minimum cost alone you have to choose. So here if you see, KO is minimum at option number 2. Now because it is minimum at option number 2, this is what is the optimum capital structure. So what is the optimum capital structure? Wherever cost is minimum, which cost? Overall cost of capital, which is PAC. Now this is the traditional method. Now if you see, we completed 3 chapters. See, nothing more is there. Okay, in capital structure nothing more is there. Now we completed 3 chapters. I mean actually 4 chapters. First is the first chapter. Okay, first chapter, intro to financial management. Okay, intro to financial management. We have discussed some theories also. Second, what we completed? Cost of capital we completed. Then we completed leverages. Then we completed capital structure. And actually I've completed, maximum to the extent possible. Nothing I've left, it seems, but even if it is left, it is very minimum and very rare chances of coming. Okay, like I would have left here approach, but very rare. Okay, very rare that it has come. Cost of capital, leverages. These are the four chapters we completed today. See, if you see the weight of these 4 chapters, okay, if you see the weight of these 4 chapters, cost of capital, why I spent more time? Because here there are chances that 2 questions are also asked. Why I spent more time here is that because there are chances that 2 questions are also asked. So if you see 5 to 10 marks, 4 to 12 marks, and then leverages 4 to 8 marks. So if you see average, here some 6-8 marks, here some 6-8 marks, here some 4-5 marks. So average, we have completed some 30% of the portion we have completed. If you see, out of 60 marks, okay, out of 60 marks, some 30% of the portion we would have completed, okay, or more than that. Now the next chapter, see, after financing decision, the next chapter that we are going to start is with investment decision. Investment decisions, 2 chapters are there. Okay, investment decisions, 2 chapters are there. One is the investment decisions only, which is also called as capital budgeting. Okay, previously it was capital budgeting, now it is called as investment decisions. Okay, investment decisions. Here capital budgeting is there. Okay, capital budgeting. The second one is risk analysis in capital budgeting. Risk analysis in capital budgeting. These two chapters are we are going to start in tomorrow's session. In tomorrow's first session, we will target to complete investment decisions, these 2, and we have 2 sessions tomorrow. Okay, we actually planned for 9 hours, but I think 3.5 hours we completed today. So tomorrow we would be completing the other 7 hours. So it will be effectively 10 hours. Effectively 10 hours. I'm excluding half an hour break. Okay. So effectively, but actually today I gave, I think, 20 minutes break. So effectively, 7 hours is pending. So in this 7 hours, our first 3 hours target will be to complete investment decisions and risk analysis in capital budgeting. Okay, to complete investment decisions and risk analysis in capital budgeting, and then we will start with dividend decisions. Okay, dividend decisions, and then working capital management, and then we will do ratios. So if you see 1, 2, 3, 4, 5, and then these 8 chapters. Okay, 8 chapters, and one chapter is this types of financing is theory chapters. What is one chapter that is left? Out of those 10 chapters, 4 chapters we already completed. Other 5 chapters. Okay, 4 chapters we already completed. These are the 5 chapters that we are planning for today. This second chapter, because I think I will not be adding any value into the discussion, that is the reason I will ask you to read this second chapter. It is complete theory chapter, nothing practical is there. Okay. Now here ratios I will not be giving much importance because it is purely calculative and it is purely on the accounting side only. It is purely on the accounting side, and I'm very sure most of you will be knowing this ratio chapter. Okay. Now what I found is that on 3 chapters alone, students are facing difficulty in solving problems. Okay, in solving problems, students are facing difficulty only in 3 chapters. One is capital budgeting. Okay, capital budgeting, students are facing problems in solving the problem. Okay, second one is working capital management, and the third one is this ratios. And solving this problem, students are facing this difficulty. So if tomorrow time permits, we will solve at least, okay, at least one questions from these 3 chapters. Okay, at least one questions, a proper questions in these 3 chapters, but that is not our agenda. Okay, that is not our agenda. So this is the plan for tomorrow. Okay, today we completed these 4 chapters, and tomorrow in 7 hours, actually time is more. Okay, time is more. That is the reason I've included questions. Now one more thing, there are 2 types of revisions. One is the concept revision, and second one is the problems. Okay, second one is the problems, how to approach the problem, how to solve the problem, how to write the problem, what are the tips, tactics to solve the problem, how to solve the problem is the least time possible and in the more accurate and the more proper way of presentation. This is another way. So on the second part, I'm not focusing very much. So Saturday and Sunday, okay, Saturday and Sunday, we are having one more class, not in SICASA, at one other place. That is also free class. So that I'm conducting. Day 1 will be concept. So anybody who is seeing this video will not attend day 1. Okay, should not attend day 1 because whatever I'm speaking now is what I'm going to speak Saturday. Sunday, I will be devoting completely to problems. So if anyone who wants to, attend that, you can also DM me. Okay, you can also DM me. I can send you the details, or I will ask SICASA to send you that details personally. And if you have any doubts, okay, you can always reach out to me. I'm giving you my number 90256 73914. Okay, Thofik Tufel is my name. Okay. So any problems, do reach out to me. So one thing what I would request is anyone who is seeing this live batch, at least message me once so that I'll get to know how many people have saw this video and how many people have benefited from this video. You know, as a student, as a teacher, I'll be happy if students are actually understanding things. Okay. So anything you felt, okay, this was not good, that was not good, or somewhere where I did a mistake, or anything that this was good, or this is something that I learned new, let me know. So, things will be always two-sided. So this is all for today. Let us meet tomorrow for the rest of the completion. Otherwise, I'll uh, give it to SICASA or Kavin. You can take it up and close it.
Thank you so much for the wonderful session, sir. One thing, can you please share the formula material PDF? I can share it in the group. And otherwise, your session is great, so thank you so much.
Okay, formula PDF means you're asking this or you're asking a separate PDF?
First, you have shown like cost of capital formulas and
Cost of cap. Oh, you mean my handwritten notes you're asking, or you're asking some typed notes?
type notes.
Okay. Okay, you mean
Uh,
to say this one?
yes. Yes,
Okay,
that's
okay.
formulas. Only
Yeah, okay.
formulas, if possible.
Okay, sure. See, these are nothing but the PPTs, but I'll share a different material which is ICAI material only, where proper formulas are given. I'll share with that. Okay.
Sure, sure, sir.
Mm-hmm.
Thank you, sir.
Okay, sure. Thank you very much.